from New York City this morning. Good morning. Futures down by 1.5% on the S&P and the Nasdaq down by 1.7%. Another round of talks between Ukraine and Russia scheduled for today in the next couple of hours. Expectations for that very, very low, as you might expect. That's the equity story. Down, softer in Europe, same issue. Switch on the board and get to the bond market. The relationship between commodities and treasuries. We can talk about the levels and we can talk about the spread between the two. I'm talking about 2s and 10s. Closing last year at 77 basis points, and now the spread between the two, just a third of that level. Lisa, this conversation around treasuries gets a whole lot more complex and complicated from here. What do the moves in Brent crude and WTI, up 6%, 125 and 122 respectively, mean for that Fed conversation in a week's time?
Well, typically there's been a big debate about whether higher oil prices is inflationary or disinflationary. And right now, people are saying longer term it's disinflationary, but the Fed still has to act in the near term with a lot of pervasive inflationary trends. And this is a complicated, very delicate picture for them.
Everywhere you look right now, you see inflation, and now you see demand destruction. That's the bigger issue. How do we price that in? Switch on the board and let's talk about Europe briefly. Euro Swissy with a break of parity overnight. Unchanged now. But Tom, that move, if you take the chart back to 2015, you remember that time. Wow, what a move. Euro Swissy, a break of parity. As we start to think about an ECB that can't get away from negative interest rates again. And for the European banks, it's not just about the direct exposure to Russia, Tom. It's about the interest rate story. Down again in Europe on the bank segment, that industry group down by 4.5%.
I emphasize, John, here the importance of Switzerland, and that they've come off their neutrality statement a number of days ago, which was stunning to see. And the idea of second round effects from the visible that we're all considering 24/7. There are knock-on effects that can all of a sudden be important.
Switzerland's been talking about currency intervention, Tom. They've had deeply negative interest rates for a long time. Can they really do anything about that? Euro-Swiss parity. Can they do anything about it?
We don't have the window here to talk about it, but the answer is you're right, John. It's an extremely difficult thread they are trying to put through the needle. This is a joy. Not that it's Ian Bremmer, president and founder of Eurasia Group. I'm going to read you a single sentence from December of this year. If Putin doesn't get concessions from the U.S.-led West, he is likely to act. One of the top risks for Dr. Bremmer and his Eurasia Group, and he joins us here this morning. Ian, I want to frame forward with you. I want to get without the breaking news that you've been on all weekend. The end of the free market. One of your books talks about that adjustment from free market to some form of new capitalism. What does President Putin or whoever's after Putin, what does their free market, what does their business structure, what does their command economy look like in 2 or 3 years?
Well, it's not autarkic. I mean, we talk about Putin as if he's a global pariah. That's, of course, not true because it's a G0 world. You can't make someone a global pariah. But he is a pariah in terms of the advanced industrial economies of the world, the G7, as it were. So what does that mean? Well, when you have the Chinese government saying that the relationship with Russia is like a rock, that means that you're going to see far more integration of Russia into the Chinese economic network, both in terms of the technology that supports the military-industrial complex for Russia, the financial transactions that allow them to function as an advanced economy, and of course also the energy flows and infrastructure that will need to be built, not just in terms of oil production and export, but also eventually for gas that'll be moving towards China too. Russia will also be working with a lot of other developing countries around the world, the Gulf states, India, Brazil. China is going to be absolutely critical for the Russians.
Ian, how do we adapt? How do we move from 2008 in Bucharest, NATO, where Gates and Rice begged the United States to not sell democracy to the far east of Europe? How do we adapt to a new regime where just maybe possibly we can't sell democracy 24/7?
Yeah, the fact that the American model of democracy is seen by China as past its sell date, and they're going to be the largest economy in the world, means that we're in a hybrid system. It's competitive. The big question I have here is not about the tilt of Russia, because Russia, of course, we've been steadily losing for decades now. It's rather whether or not new technologies, which are top down, the data and surveillance economy, actually facilitates authoritarian consolidation and also undermines civil society in ways that can't be redressed. Back in 2008, technology was something we thought of as supporting democracy and undermining authoritarian states. Think about how it was the Soviet Union collapsed. Think about the Arab Spring and the colored revolutions. Well, those are all quaint and in the backview mirror right now. Instead, technology is what allows the Chinese to repress 1 million Uyghurs, and it doesn't lead to any demonstrations on the ground. Why? Because they can monitor and police the behavior of every single citizen. If the Russians can do that, if other smaller economies can do that, that's a big challenge to American democracy.
Ian, a lot of people right now are hoping for the bandwidth to worry about selling democracy. Right now, people are worried about selling wheat. They are worried about selling nickel and aluminum and corn and soybean oil. And what we are seeing right now is China coming out over the weekend and saying that domesticizing food production is an issue of national security. We have heard from the U.S. supply chain security is a national security issue. How much are we seeing a pivot point moving to the mass deglobalization of our economy?
Well, I mean, I'm glad you brought up grain in particular. When you have the largest grain producer in the world invading the 5th largest grain producer in the world, one would think you're going to have big food problems. And certainly coming off the pandemic, where extreme poverty, after decreasing for decades, is going up, in the next 12 months, this is going to be absolutely critical. And you're going to see a spike in starvation around the world. Yes, in Afghanistan, but also across sub-Saharan Africa. And when you have pigs in Europe and the United States fighting for grain supply that will allow wealthy people in the world to eat the meat that they want, competing with people in the poorest countries in the world that can't buy that grain for themselves, you can see that the globalization of the world that had been leading to an increased global middle class is now unwinding, especially on the back of this crisis, which frankly, I mean, the Russia-Ukraine invasion is going to be worse for global poverty, in my view, than when all is said and done, than the pandemic has been.
Ian, that's a pretty dramatic statement. How will this conflict rearrange the economic outlook as we know it?
It's going to increase inequality because, you know, when you have massive supply chain challenges and when you have energy price spikes, it doesn't affect nearly as much the wealthy around the world who have the ability to move their assets. They have the ability to change their lives. Who gets really stuffed? The advanced economies can do more even to help support their poor and middle income economies. But the emerging markets have vastly more debt on their books after the last 2 years of crisis and now don't have any more flexibility to help their populations. But this is a massive shock to their imports coming down the pike. Okay, not for the major commodity producers who benefit for higher prices, but if you're on the other side of that trade, you're going to be hurt dramatically coming out of this.
And Dr. Bremer, let's steal something from Fareed Zakaria here, and let's talk about not the post-American world, but the post-Putin world. I read a lot this weekend on Mr. Putin's inner circle, his defense minister who never served as a professional army guy, etc. What does the post-world? What does the post-Putin world look like for Russia?
Well, we'd have no idea if it's going to be in 20 years or in 20 days. It's important to recognize that the likelihood of removing Putin from power is extremely low until the moment that it happens. And so it's not very useful to speculate on when it could happen, but it's important to understand that the pressure is there. And of course, that leads to more erratic behavior domestically for Putin himself, who in the last week has been taking all sorts of measures to create a North Korea-style police state that just doesn't work well for a country of relatively educated 150 million digitally literate Russians. And you know, it's true that the average Russian believes what the Russian state media is putting out, but a lot of urban younger Russians do not. And the 10,000 Russians that have already been arrested for nonviolent protests against the war, as the economy starts to literally implode in the coming days, and you don't find goods on shelves and you have to ration and people don't get their wages, some of those are going to turn violent and the Russians are going to repress it. So we have to at least consider that, you know, one of the only ways this potentially gets resolved in the near term is if you have a dramatic discontinuity in Russia itself. And that's a very hard thing to plan for in a country with 5,000 nuclear weapons.
Ian, thank you. As always, sir. Ian Bremer there of Eurasia Group. One thing we might get down the road, a default. The chances of that increasing. The headline crossed the Bloomberg just moments ago. We're pricing that in at 80%. This has got really complicated. The team at Bloomberg have written a story on this, so I'm going to read the second paragraph for you from Irene Garcia Perez. It reads as follows. Authorities said Saturday that Russia and Russian companies will be allowed to pay creditors from, quote, countries that engage in hostile activities in rubles, even on securities denominated in other currencies. Those countries, Lisa, include the US, the UK, and EU members. This has got so complicated so quickly.
Complicated in order to avoid a default, to try to avoid being removed completely from the financial system, but it's unclear whether it will even work.
I have to admit, I can't keep up to speed with what's happening, who gets paid, who can get paid, who will be paid, on what debt, on which debt.
Isn't that the point?
Yeah, it's confusing in a major way. 122.75 on WTI at more than 6%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. The European Union is calling for fast action to ensure the safety of Ukraine's nuclear power plants, 2 of which have been seized by invading Russian forces. In a letter to the International Atomic Energy Agency, the EU Energy Commission urged Moscow to return control to Ukraine. It said missile strikes at Europe's largest plant and its recent takeover are unacceptable. A decree signed by Russian President Vladimir Putin will allow Russia and Russian companies to pay foreign creditors in rubles. It establishes temporary rules for sovereign and corporate debtors making payments to creditors from countries that, quote, engage in hostile activities against Russia. Russian corporate bonds denominated in foreign currencies have plunged to deeply distressed levels in recent days. And a teenager from Florida who shot to fame tracking Elon Musk's private jet is turning his sights on the yachts of Russian billionaires. Jack Sweeney started tracking the aircraft of Russian oligarchs at the end of February. He says he's now following their yachts as Russia's elite come under pressure following Russia's invasion of Ukraine. And China has announced a GDP goal of about 5.5% for this year, at the higher end of many economists' estimates and quicker than the 4.8% expansion forecast by the International Monetary Fund. Beijing is expected to stimulate the economy, loosening controls on the housing market and increasing infrastructure investment. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The first step in building a connectome is to get your hands on some brains and then cut them up. It all sounds very grim, but Harvard turns out to be quite efficient with its brain harvesting. Jeff's lab can do a year's worth of research with a single mouse brain. Small chunks of the brain are fed into the slicer, where a diamond blade carves off a thin sliver of tissue. The tissue floats along some liquid and onto a piece of tape. The brain slices are then put into this very large machine, where they're photographed in the finest of detail. Software helps stitch the pictures back together into a single 3D image, and algorithms are applied to help make sense of what's going on inside of the brain.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We are now talking to our European partners and allies to look in a coordinated way at the prospect of banning the import of Russian oil while making sure that there is still an appropriate supply of oil on world markets. That's a very active discussion as we speak.
Was that admission a strategic mistake? We're going to talk about that in just a moment. Secretary Blinken on CNN over the weekend. Futures are negative, down by 1.4%. On the NASDAQ, down by 1.5%. Off the back of those comments from Secretary Blinken over the weekend when this oil market opened up to the moon. And to your point, Lisa, some of this was like watching meme stocks take off. Close to 140 on Brent. Brent backs away 124.59 now. WTI 122.54. Javier blasts out on Twitter this morning, Tom, of Bloomberg Opinion, on fire. We're at this strange in-between moment now where the administration has admitted they are considering it, sending crude higher. At the same time, Russian crude isn't banned, so ultimately Russia's getting better prices.
Well, we will have to see. I mean, as Javier has mentioned, it is a story in motion. When everything's said and done, what we know is it's about the markets, and the markets are stunning price rises in oil. Mr. Blas joins us now. I can't say enough about his book on this moment. Javier Blas, I guess somebody's making money going up. Who's taking the losses right now?
Well, you and I, when we go to the petrol station, because we're going to pay a hell more for the gas and the diesel, that's for sure. Consumers are going to be suffering. Prices are very high. And it's not just the oil, which is a big part of the story. I'm more worried here in Europe about the price of natural gas, which is still about 35% as we speak. It went even higher today. Just to put this into context, because we get confused about the different measures of natural gas prices, I'm just going to put it in barrels equivalent of oil. Right now, the price of gas in Europe is about $450 a barrel. European consumers are paying $450 a barrel for oil.
Javier, you start your book on the swashbucklers of the moment. I agree, they're out there. Who within the financial system takes a loss? Is it EU banks? Is it derivative and commodity traders of tangibles like oil, like wheat? Who takes the losses within the financial system?
In the financial system, some traders are taking losses for sure. Some utilities, European utilities, are taking big losses right now. And they are going to continue in the days and weeks to come. And what worries me there is, do we are in a situation in which we are about to see something breaking? Prices have moved with such a magnitude and such a speed that for some of the commodity traders, it's going to be a very difficult situation to handle. And they're going to face this afternoon, in a few hours, huge margin calls that we don't know exactly how they are going to handle. And we don't know what is going to happen tomorrow either.
Can we fix things before they break? Javier, I just wonder what frustrates you more at the moment? The strategy of the administration, of the European governments at the moment, one, or two, the lack of a response from the oil patch, from private companies in America, and from governments like Saudi Arabia in Riyadh?
You're going to have to restrain me, John. I mean, all of that is getting me absolutely mad, to be honest. I cannot understand the U.S. oil industry. It's $125. Just go and produce the oil, and you say that you are going to help. Messages like we are not going to increase production even we hit $150 are not helpful right now. From the administration, I don't know what they were thinking yesterday when you don't make an announcement that you are considering putting a ban on exports of Russia, which is the third largest oil producer, the second largest oil exporter, unless you have everything lined up. At the moment, as you said earlier, what we are getting is Russia is continuing exporting his oil and his gas, and we are giving it much higher prices. So the Kremlin is making a lot more money today than it was making on Friday.
But Javier, is any of this surprising? I mean, we all knew they were considering further sanctions, particularly and including oil and gas. And we see already a de facto self-sanctioning. We've been talking about that for a couple of weeks. Shell kind of exemplifying this over the weekend, making apologies almost for buying discounted crude from Russia. How much would it actually change the on-the-ground reality if these sanctions were to go into law?
I think that it will change significantly the situation. I mean, some of the oil is still flowing. Despite the self-sanctioning, some of the oil is still flowing from Russia. Everything through the pipeline is. All the natural gas is flowing. I mean, actually, more gas is flowing into the European Union right now than it was flowing before the invasion of Ukraine. So, yes, it will really change the situation on the ground. And I think that even if everyone in the market was speculating that this was the discussion, it's very different to speculate that to hear a state secretary on the record saying, actually, this is the discussion. And not only is a discussion for the United States government, it's also a discussion that we are doing with Europe.
Javier, a lot of people have pointed out that Russia only accounts for 3% of the imports of oil to the United States. Is this really about the alliance with Europe more than anything else?
Yes, it is about the alliance with Europe. I mean, actually, the number is higher because you are absolutely right. It's 3% for crude, but when we include the refined products, it goes to 8%, which is a significant number. The United States imported more refined products and crude oil from Russia last year than it did from Saudi Arabia. And I don't think that anyone in the United States will say that Saudi Arabia doesn't matter for the supply. But it is a signal. If the United States ban imports of Russian oil, it's going to be untenable for Europe to continue importing oil. It's just politically will be untenable.
Javier, do you think it would make a difference if the president got on the phone, got the oil majors together in the White House and had a meeting like they have a meeting with the EV players and talked to them about boosting production? Would that move the dial? Would it make a difference?
I think it will be a huge difference. I think that the president needs to do that, needs to bring the oil industry and send a message. I think that probably not only just the oil industry, it needs Wall Street, because the oil industry is going to need the support of Wall Street banks to drill more, and we are going to need it. It's not easy. It's not the switch of a flick. And let's be clear, the U.S. shale industry cannot replace Russia. It will be able to increase production over time, but they cannot replace alone Russia. So we are going to need other countries, particularly the Saudis, to help. But I think that the thing that I consider the most urgent that policymakers need to do, and that's not only for President Biden, but I think it's very important for policymakers here in Europe, is they really need to talk to the nation, and they need to prepare then that this is going to be painful, that this is going to be economically going to be very difficult over the next few days and weeks. But it's something needed if we are going to defeat the invasion of Ukraine. Because at the moment, they have not really prepared public opinion, but what is coming. And public opinion is about to see it. Already they are going to see it. Gasoline prices are starting to go up very quickly.
Javier, wonderful as always. Javier Blas there of Bloomberg Opinion. The chart that captures this conversation, Tom, it's a very simple 12-month chart of European gas. Right. And the twin peaks of that chart, the pressure that we saw going into Christmas, into the back end of December, and then look at the move at the top right.
Yeah.
So this is a double shock, Tom, in just several months.
It's really important. This is standard deviations. Folks, the pros look at the percent movement off of roughly 20-day look back. It's called the standard deviation. I'm not going to go into the math on a Monday, John. Central limit theorem we did Saturday night. Here's the answer. We moved from 2 standard deviations out to many, many indices at 4 standard deviations. I call that, John, when I lecture, that's a medical chart. These are like medical charts in a hospital.
Nat gas prices surging, crude higher by more than 6%, approaching 7 percentage points higher now on WTI, 123 and 70. From New York, this is Bloomberg.
Almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja, belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
the volatility we're seeing is something that gives people pause.
I mean, you're dealing with growth slowing and inflation going up.
We're going to see price rises continuing for quite some time.
It puts us as investors in a difficult position that we can't really look to the interest rates falling.
The market's saying is that the Fed may overdo it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Crude absolutely surging from New York City this morning. Good morning for our audience worldwide, live on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down by 1.2% on the S&P, off the lows, crude off the highs. Brent still 125, TK WTI 123.
Hugely fluid right now. They come up, they come back. Right now, oil coming up a little bit. I'm using dollar ruble really as the Russian litmus paper. I don't think there's any surprise there, John. But one thing I do want to mention as we go into this hour, this is a morning where EM begins to break. Javier Blas tweeted out about that about 3 hours ago. And I just suggest, John, out of the side here, we got to look at emerging market and how they adapt.
And just got a headline, Tom, on some talks between the British Prime Minister Boris Johnson and the President of the United States. Boris Johnson saying we need to do more on sanctions against Russia. And that's the story this morning. The administration openly stating they are considering banning the import of Russian crude.
Well, the basic idea in the Telegraph, I think, associated with the conservative movement in the United Kingdom has really been out front on this, John. But what's your treatment on it? Not so much how is Boris doing, but what is the tech you perceive from your prime minister?
Can the UK join them? Will the Europeans join as well? It is a much, much bigger deal for the Europeans. And that's why I think the reporting from the team down in Washington this morning here at Bloomberg, Lisa, the suggestion that at the beginning, if they do this, the U.S. could be flying solo.
That they could be flying solo at a time when you see natural gas prices in Europe surge to new record highs. And as you pointed out, that chart, just a catastrophic move for people who depend on gas in Europe, which is pretty much everyone for their heating. And you do wonder, does this lead to a stagflationary kind of feeling in Europe that is very different than what's in the U.S.?
Demand destruction. How many times have you heard that over the last couple of weeks now?
Well, honestly, that's the question. What is the threshold where it becomes a self-correcting cycle? We don't know. Lori Calvasina of RBC saying she thought we would have already gotten there. The fact that we haven't is concerning.
John, I don't agree with the microeconomics of demand destruction, and that so much of the things we're talking about are not substitutable. Nickel is not substitutable in a lot of modern technology, and the agonizing gas prices in Europe, are they substitutable? I don't think so.
Tom, we talked about this last week. You and I did. What do? You spend less elsewhere.
Yeah,
Isn't that going to be the bigger issue?
I think that's a bigger issue, and this gets over to the income statement versus balance sheet analysis that I saw all weekend from our clients, Global Wall Street. Everybody's wondering, what's the income statement effect to pick on Total? They're in the news in France, and what's the balance sheet effect on Total?
And the earnings story more broadly on the S&P 500. Futures this morning down a little more than 1%. I'll whip through it for you. We're down 48, call it 49 points lower on the S&P 500. The Nasdaq down 180, down by 1.3%. Crude higher by 6.6%, 123.33. Yields aren't doing much. Up a basis point on 10s to 174.26. And this dollar's stronger. Euro dollar, Lisa, 108.62.
This idea that perhaps the U.S. will be in a better or lesser pain than Europe in the face of this shock. The big question for a lot of people is, what's the off-ramp for this conflict, and what's the off-ramp for the surge that we see ongoing in commodities today? The U.S. Secretary of State Tony Blinken will be meeting in Latvia with the president there, as well as the Latvian and Israeli foreign ministers, to talk about possibly some sort of Iran deal, possibly to get an increase in the production of oil, as well as how to handle this Ukrainian invasion. Do they get on the same page? And this comes not only as crude surges to the highest since 2008, both on the Brent and WTI fronts, but also as gasoline surges at a very rapid pace, above $4 on average a gallon in the United States for the first time, also going back to 2008. We would otherwise be talking about the fact that the pandemic evidently is over. Today, some school mask mandates are lifted, at least for the New Jersey and New York City regions. How much do we see the sort of end of the pandemic to an endemic phase met with a shrug because we are all focused that much more on what's happening over in Eastern Europe. And at 3 p.m., how much can consumers buffer their finances by just borrowing more? We'll get a read on the consumer credit in the United States for the month of January as you start to see a resurgence. Good for the banks, but it also speaks to the sort of dwindling savings that a lot of consumers will begin to have as this conflict drags on.
Lisa, thank you. In this hour, we begin with our top story. The U.S. administration considering banning the import of Russian crude.
We are now talking to our European partners and allies to look in a coordinated way at the prospect of banning the import of Russian oil while making sure that there is still an appropriate supply of oil on world markets. That's a very active discussion as we speak.
Secretary Blinken over the weekend. Team coverage starts right now with Bloomberg's Anne-Marie at the White House, Maria Tadeo in Brussels. AMH, the story of the morning, are they willing to fly solo on that effort?
Great question, because as you've seen already with all the sanctions, they really worked in lockstep between their European partners, with United Kingdom, even Japan, to make sure that this was something that was really multilateral in name. And now this would be the United States acting alone, going it alone in banning these imports. The political pressure is intense in Washington on this White House. But we should note, right now, there's an embargo all but in name. You have refiners in the United States ditching some of this crude. 3% of imports come from Russia when you look at hardcore crude, 8% when you consider all those other fossil fuels that are important. But the signs are there that they are looking to do this, because you have U.S. officials going to Venezuela to potentially make up some of that shortfall. Obviously, this is something that's going to happen. It's a matter of when, not if.
Anne-Marie, in your world, what is the dynamic of going from AAA unleaded printed this weekend $4 a gallon out to $4.10 or $4.40 or, dare I say, higher? How does that change the dynamic inside the Beltway?
Well, already for months, you've seen poll after poll. What do U.S. consumers and Americans say? That they want more action being done out of Washington, and that is inflation. It's gasoline prices, it's food grocery bills, it's all of the above. And this will just make that domestic issue so much harder for this White House.
Maria Tadeo, we have gotten some word from the Kremlin as far as what they are looking for as we all look for an off-ramp to this conflict. And recently they said that Ukraine must amend the Constitution, reject claims to enter any bloc, and a series of other demands. What do you make of the latest out of Russia?
Yeah, that's a very good point, because what they say is the Constitution, as you know, has to be changed in Ukraine as it stands, because right now it says the country aspires to join the European Union and NATO eventually in the future. Now, what the Russians say is that if that gets tweaked, and on top of that, the Ukrainian government recognizes that Crimea now belongs to Russia, but also the 2 breakaway provinces would be part of the Russian Federation, that would be a good start to stop the fighting. Now, these conditions, if you look at them as a whole, you would argue, well, this is unacceptable to any country. But the reality is, compared to a week ago when Russia was essentially asking for full capitulation, the language is now much softer, in fact. A lot of this perhaps to do with the sanctions that, of course, are kicking in for Russia. Right. But this, I would argue, is a step down from what Russia asked for a week ago, which was obviously complete capitulation.
Maria, what is your reading over the weekend and reporting on simply the Baltic states? What is their vulnerability this Monday?
Well, Tom, every official that I spoke with here in Brussels on Friday and Saturday from the Baltics is incredibly concerned. They also point, by the way, and we're not talking enough about this, Moldova. They also worry a lot about that country and the spillover effects that it could have in Moldova. They want to see more NATO troops, of course. They're also very open about a full embargo on Russian energy. Today, Tony Blinken is in the Baltics, has been to Poland, and these are the 4 countries that would tell you, you want to ban it, we'll sign it any minute from now.
Maria, thank you. Maria today in Brussels, alongside Anne-Marie down in Washington, D.C. There goes another one. Lisa, Levi Strauss, suspending commercial operations in Russia. I've lost track of the list now.
That was what I was going to say. It was a drip at first, and it's just become an absolute flood of companies exiting as quickly as you can. Airspace, leasing of planes. How often are we going to start to see parts being suspended? How long can Russia continue with their military operation if they don't get basic supply chain inputs that they get from around the world, John?
Crude, 123. WTI, Brent, 125. Paul Sankey of Sankey Research, Tom, has some things to say. Here's the quote. There is no capacity to increase U.S. oil production faster than already planned pre-Ukraine, based on lack of labour, lack of steel and pipes, even lack of cement, any attempts in the short term to increase production will simply increase inflation, he goes on to say, because capacity would have to be competed away from existing plants. We're going to hear from him, Tom, in about an hour.
John, this is so important, and the key phrase there, folks, is what I mentioned before, which is on demand destruction, is competing away. It's a substitution effect, not of oranges or apples, but of labor. And it's a different, Mr. Sankey is correct there that in a constrained economy, you're up against constraints that are unbudgeable. And this goes again to the rigidities, John, within the system. On commodities right now, off year end, the blended Bloomberg commodity index, which is very, very good math, and I would say not third world as much, John. We're up 34% on that index off of year end. And what's frightening, John, is the oil component of that and the gold component are like, well, you go, okay, great. The wheat component is a paltry 4%. And in so much of the world, that is not the case. That's the kind of tensions we're seeing.
How does the supply side respond? To put it simply, Lisa, it's much more difficult than you think.
And frankly, there's an issue of whether they can, because a lot of the even OPEC nations, forget about the domestic production in the U.S. as we're discussing right now, but OPEC nations can't even keep up with the targets right now, which really raises an issue of how high could prices go at a time when things were already tight and people evidently want to travel again. So do they just cancel their travel plans?
Who would you rather be? Chairman Powell next week or President Lagarde this Thursday? Who's got the harder job?
I think I'll take a pass on both. I think that honestly, Christine Lagarde has the harder path because of the euro and where it is and the increase in inflationary pressure as Deutsche Bank has been talking about.
Euro dollar threatening to break 108 seemingly at one point this morning. 108 right now and backing up. Futures are off the lows. We're down 0.9%. We recover just a little bit here. Crude well off the highs. That move yesterday evening was a wow move. 123 on WTI, up by 6.3% with Tom Keene and Lisa Abramovich. I'm Jonathan Ferro on radio, on TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. An advisor to Ukraine's president says the next round of talks with Russia will begin later today. Russian forces have stepped up their nighttime shelling of cities in the center, north and south of Ukraine, according to a Ukrainian official. That comes as an evacuation from the southern city of Mariupol has been stopped for a second day. Ukrainian officials claim Russia has again violated a temporary ceasefire deal brokered to allow the safe passage of civilians. The U.S. House of Representatives is looking at a bill that would ban the import of Russian oil and energy products that could add to economic pressure on Russia following its invasion of Ukraine. The Biden administration is said to be thinking about making the move on its own if it can't get its European allies on board initially. And South Korea is seeing a record early voter turnout, even as the country battles its worst outbreak of COVID-19 infections. More than 16 million people, almost 37% of the total electorate, are said to have already cast their ballots. That's 11 percentage points higher than the last election. And the death toll from COVID-19 has crossed the 6 million mark as the pandemic enters its third year. That grim milestone was reached despite the distribution of vaccines that have slashed fatality rates in many areas. The latest 1 million recorded deaths came more slowly than the previous intervals, but the pace has returned to what was seen during the first year of the pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think there's very strong bipartisan support to cut off Russian oil and gas sales to the United States. It's anathema, I think, to many of us in Congress that while we were sanctioning them and trying to cripple their economy, that we would help them in any way by purchasing their petroleum. But I think the administration wants to make sure that we work with our allies.
Congressman Schiff over the weekend. Catching up on the oil story, futures negative 0.7% on the S&P. On the Nasdaq, we're down by about 0.8%. Yields higher by 4 basis points, 177. Crude up 6%, 122.74. The main event this morning, a conversation about America considering a ban on the import of Russian crude. Will the Europeans join them? Are reporting this morning, Tom, suggesting the U.S. might fly solo for a brief period of time, if indeed they make that call.
Now, listening for a response from Moscow as well, but yes, the aloneness of the United States. And John, do we combine it and say the aloneness of the United States and Great Britain?
Perhaps the UK comes along for the ride, Tom.
Yeah.
Clearly, the dependence of mainland Europe on Russian commodities is higher than the two other nations we're talking about.
I want to make clear, I don't have a good quote on wheat yet. I've got a quote on corn up 2.9%. We're watching a commodity complex. Gold up $25, $19.92. We had a 2,000 print for a cup of coffee this morning. Right now, an update from Christian Muller-Glissman, Managing Director of Portfolio Strategy at Goldman Sachs, where they followed the money this weekend. Christian, I want to talk about the EU banks, and off of a note from UBS and also what Goldman Sachs is doing this morning. What is the risk to the EU banks, and is it particularly the dynamics of the income statement or the balance sheet that you're focused on?
Well, listen, I think it started to transpire what type of Russian exposures the EU banks have. And for some of the kind of larger exposures, we've had obviously Societe Generale come out, we've had Raiffeisen Bank come out, ING. I think for all of those banks, there's some sizable exposures to Russia, which might actually hit the balance sheet and the income statement. Outside of that, you're looking at the usual kind of impacts from mark-to-market risks on assets, kind of trading losses that might come through. And obviously, the whole story on net interest margins, this whole idea that higher rates can actually support the banks, I think that's breaking away.
Thank you. The interest margin question, I'm going to call that over on the income statement as well. But do we have exposure here, which I'll use as a general phrase? Are we risking write-downs within continental Europe?
Listen, it's impossible to rule out. We have the data from the Bank of International Settlements that shows a decent amount of Russian exposure, which seems to be concentrated on a few specific banks. But then you have a lot of exposure you might not be able to track, which is indirect, which is via particular loans, via corporates that might have issues on the cash flow side. So I think we'll have to go through it to fully understand it. And I think then you have the second order effects, which you were mentioning earlier. A lot of traditional businesses might actually have production shutdowns, might have supply chain disruptions. So that could hit their cash flow. I think the only good news we have is that coming into this crisis, you've seen a significant amount of balance sheet repair, both in the banks and outside of financials, which means that the corporate sector was in relatively good health, better health than when we entered the COVID crisis, as we're now dealing with this.
And thank goodness for that, because this could be much worse. Christian, you've written recently, the team over at Goldman, about the difference between the size of, say, an equity fixed income market and a commodity market, and the outsized impact of a relative shift from one to the other. Throw in the fact that we're talking about a physical market. Christian, do you think we fully understand the ramifications, the consequences of some of the flows right now?
Yeah, listen, it's a good point you make. We have a material shift here in asset allocation, where in the last cycle it was all about nominal assets and long duration assets. So if you got that right, your asset allocation did really well. Whereas now we know financial assets as a whole, bonds, equities, credit, they're suffering. So people want to have exposure to real assets. And there's not that many of those. You have mentioned, as you said, you have the commodities markets, but their size is small compared to the financial markets, of course. And there's limits in terms of how much liquidity you can actually get. And you can have outsized impact on those commodities, because these are spot markets. They're driven by supply and demand, very different to the financial markets that are more forward-looking, driven by expectations. But I think the other thing is, like other real assets, we're currently discussing that with lots of clients, real estate, infrastructure. If you go deep, the type of size of these assets and the availability of those with liquidity is very limited. So asset allocators are really struggling now to shift their portfolio towards real assets, which will probably be the more important shift in this cycle.
And ironically, this is asset price inflation translating to real price inflation, to real asset inflation. Have we just started on that process, or is that an explanation for what we're seeing right now?
No, you make a great point. I mean, the last cycle has driven this major new economy asset price inflation, which drove a lack of investment in old economy, capital-heavy assets, and even some of those assets might have disappeared. No, and now there's a scarcity of getting capital-heavy assets in size, and this is a process which I think Tom mentioned earlier as well, could take a long time to actually build up these investments and these investment opportunities for investors, which are related to infrastructure spend, energy spend, all of these things.
Okay, so Christian, you're on your 14th call this afternoon. Not that I know your calendar, but I'm going to guess you're going to get out to 14, even 18 calls. What is the Goldman Sachs timeline with institutional equity given a war in Ukraine? Is your timeline 3 weeks, 3 months? Do you go out and say short term is 3 years?
Listen, I think you got to take the information as it comes. I think geopolitical risk is uncomfortable for all of us to take a view on, and difficult, obviously. So I think for us, this is definitely an issue which is now dragging out longer than I think most people would have expected. And there's a risk that it will continue, and the longer it drags on, and we're talking about weeks longer, I think the more economic damage it will do. And we're learning that as we speak. The good news is that I think markets have not been complacent at all on this in the last few days. The opposite, like we're seeing a lot of signs of positioning reduction, aggressive repricing of risk premia. Dislocations are starting to emerge for the first time now in the last few days, where we're starting to really see aggressive positioning shifts. So that tells us, as always, markets are often ahead of the fundamentals. That probably next few weeks already will create opportunities to maybe lean against the bearishness.
Christian, awesome as always. Christian Müller-Glissman there of Goldman. A long time ago, I got my fixed income education from Steve Major at HSBC, my commodity education from Jeff Curry at Goldman Sachs. And Lisa, I remember he would say repeatedly, equities are an anticipatory asset class. Commodities are physical markets that need to clear demand and supply at spot. With that in mind, at some point, I have no idea when or if this will happen, but perhaps at some point we wake up on a morning where crude is rallying and energy equities are not participating. That's one to watch.
That's one to watch when people start to book flights and they say, wait a second, this price is way too high. I'm not going to take that flight, or I'm going to drive less because of the cost to fill up my the tank. And how much is that what we're looking for the breaking point here to break the cycle?
Futures this morning down 0.6% on the S&P. On the NASDAQ, we're down by 0.7%. As this session grows older stateside, equities continue to recover and yields keep climbing at 4 basis points, 177.51. Crude backing away from session highs, 121.40, up by almost 5%. Heard on radio, seen on TV. This is Bloomberg Surveillance.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Your top story this morning, the United States openly admitting they are considering a ban on importing Russian crude. Will the Europeans come along the ride, or will the US fly solo? Futures negative 0.5%. We recover here on the S&P. On the NASDAQ too, down just 0.6 or 0.7%. In the commodity market, it looks like this right now. Brent and WTI absolutely surging overnight when that opened up, approaching 140 on Brent, now backing away. Brent right now 124.60, up 5.5%. The relationship between what's happening in the commodity market and what it means for the Fed has been totally blurred over the last couple of weeks. We kind of got a good feeling for what the Fed might do this year, and now seemingly no one's got a clue. The good news, the quiet period for the Fed this week has started. You won't hear from them. Twos right now, 152.41, 10s at 177.51, anticipating this Thursday when we get US CPI at 8:30 Eastern time, and seconds later you hear from the ECB president. What has President Lagarde got to say? Let's finish on Europe, switch up the board, and look at the European names, the European banks specifically. We're down 2.5% of session lows, but Tom, in one single month, 30 short days, that particular segment, that industry group, is down 25%. It has been ugly, ugly, ugly.
They're in the heart of it as well, but so much of this is uncertainty and how they're going to mark-to-market their balance sheets going forward. I get the idea it's an income statement effect here. Revenues will be down, as we just heard from Mueller-Glissman of Goldman Sachs. But, John, to me, this is about either direct write-downs or second-order effect write-downs.
And an ECB, Lisa, that just maybe won't be able to hike anytime soon. Do you remember the story? How many people did we speak to at the start of the year? By these names, the ECB is going to make a move. This story's changed everything.
And if they come out and they confirm that they're not even thinking about making a move this year, what does that do to the euro, which already is tanking?
And we haven't even talked about the Swiss National Bank with Euro Swissy through parity for the first time in many, many years overnight. That's your cross-asset price action. Let's get you some single names and say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Of course, you know the equity markets are a forward pricing mechanism, at least in theory. The commodity market, though, well, that price is in the here and now, and right now you're seeing the intersection of both of those worlds here. When you look at the pre-market movers, everything to the upside right now is pretty much tied to the commodity space in some way or another. Exxon, Marathon, Oil, Chevron, all higher here in the pre-market. Occidental shares up about 10% right now. And it's not just the big majors, oil majors out there that are moving higher here. A lot of the smaller independent oil and exploration companies here in the U.S. also rallying hard. Raleigh Exploration up about 6% right now on the bet, or at least the speculation, pretty intense speculation right now, that the Biden administration's policy position on renewable energy and the restrictions that it has on drilling here in the U.S., that might have to be eased in light of what's going on with the war in Ukraine. Not a lot of mining companies publicly traded here in the U.S. Newmont Mining is one of them, higher by about 2% here in the pre-market. Flip up the board, take a look at the bank stocks on the back foot once again. Citigroup shares, remember, which had that big 9% slide last week and has really been one of the big underperformers with regards to financials, down again about 3%. Everything in the bank space, in the financial space, lower here on the day. We should point out that a lot of its peers like Morgan Stanley and Bank of America have actually fared worse here over the last 3 to 4 weeks here in light of all the whipsaw that we've been seeing in the Treasury market. Airlines also on the back foot, a stunning 20% drop that we saw on United Airlines last week. It looks like it's going to add to those losses, at least based on the pre-market action, down about 2.5%. Not only are the airlines down, all the major hotels, casino stocks, Carnival Cruise Lines, all lower here in the pre-market. And if you're looking for one bright spot out there, Tom, not related to Ukraine, you're going to find that in Bed Bath & Beyond.
Yeah, I saw that with Chewy.
Yeah, up 60%. Ryan Cohen, of course, co-founded Chewy, which I'm sure you're familiar with. And then, of course, he made that big bet on GameStop.
With Chewy.
Yeah, well, there you go, Tom. If you're looking to sort of add to your bet here, maybe he does something with Bed Bath & Beyond.
Romain Bostick, important to close this afternoon. I do want to point out the VIX out to a 35 level, does better right now, 33.67 on the VIX. Standard & Poor's futures, negative 23. Right now, our interview of the day on the deepest part of the market, the most visible part in these uncertain times, which is foreign exchange. Mark McCormick has been brilliant at TD Securities with Priya Misra, talking up the idea of a resilient dollar, and he joins this morning. Mark, I want to get away from the convention because I think everybody's really not worried about buy, hold, sell on a given commodity pair. What are the indicators you see in the machinery of the foreign exchange market and bring it over to the plumbing of the global financial system? What are you studying right now to get whispers of where we're heading in terms of the integrity of our liquidity and our solvency?
Well, I think there's two. One, obviously, is the price of oil and what's driving it. If you look at the Fed's decomposition that we see on a weekly basis, this is a supply-driven shock. The other side of it is basically the currency basis swaps market. So what we're trying to figure out is how much funding stress is kind of coming through the markets, where these sources of funding stress are, which banks are kind of the most vulnerable, where the balance sheets are most vulnerable. Obviously, it's a European story. But what's clear is trying to see whether or not this is a European growth shock that is slowly morphing into a global growth shock. And that's where the links between oil come back in.
Long ago and far away in the summer of 07 and into 08, the chaos of 08, it was LIBOR, OIS. There's other indicators now. I'd say LIBOR we're walking away from. Mark, that separation of Europe and the United States, how tangible is it this morning?
Well, it's quite clear. You can just look at the basis swaps. You're seeing basis swaps across Europe blow out, and it's kind of showing you that there's a funding stress that's manifesting itself across European banks and European assets. So there's a clear divergence. And as you've already mentioned, it's on the central bank side. We still anticipate the Fed's going to hike in March, 25 basis points. The market's still pricing in 140 basis points for the Fed. And there's still some concerns about whether the ECB can actually hike rates. We still have 25 basis points priced in for this year. But it's very clear that we are seeing some divergence come through, particularly in the equity markets, the funding markets, the cross-currency markets. And all of this is like the scramble for dollar liquidity. So this is like cash is king, dollars king. And that's kind of where markets are gravitating to right now.
And several weeks ago, Mark, I thought it was really insightful of you when you came out and you said, we had been seeing this race to the bottom of so many central banks. Are we going to get the reverse of that? The race to perhaps a bit more strength led by the ECB. And we did see from David Folkerts-Lando over Deutsche Bank, they are looking for an ECB intervention, some signal that perhaps they are still thinking about hiking rates to get the euro stronger. Do you think that that is in order also?
Yeah, I think that's absolutely in play. Like we actually last week put out a trade idea to buy euro versus sterling, premised on terminal rate pricing, relative central bank pricing, relative growth, which is actually ironically quite in favor of the euro versus the UK. And so I think one of the things you mentioned, Swiss franc as well. Like if you think about what the SNB is doing, the race to the top is central banks are using currencies to try to limit inflationary pressures. What we had is a full exacerbation of those inflationary pressures over the last couple of weeks. So, what we have is a potentially stagflationary shock. But for the ECB, maybe they're more worried now about how much inflation is being generated. If you look at energy prices and you look at some of these other, if you look at food prices, if you look at the drivers of inflation, the things that are being inflated up now are the biggest components of the basket that the ECB needs to be worried about relative to other countries. So I do think there's some merit here that the ECB can't just shift purely into growth and just purely into financial conditions, because they need to be worried about losing how much the euro is going to decline and how much impact that will have on inflation moving forward. So I do think there's scope here to start to think about that. There's risks here that the weakening euro does actually force the ECB to kind of at least move in the direction that they thought they'd be in the last month. But right now, they hold steady on balance sheet policy, but you keep the rate hike in there for this year.
What about the opposite circuit breaker, Mark, of perhaps the Fed becoming more dovish than people previously expected, moving away from some of the rate hikes that people are pricing in?
That's important, I think, for general global financial conditions. I think this is the part where it's like, do you start thinking about buying the dip in equities, or you start looking for kind of some of the pro-cyclical assets? And I think this is part of the story that's kind of allowed this massive, what you see is kind of break between how currencies are trading. Like if you look at what are the best performing currencies this year, the equity markets are down, where we have a war in Eastern Europe, and Brazilian real, Colombian peso, some of these Latin American currencies are some of the best performing currencies year to date. And so I think with the Fed in mind, if you take a little bit off of the hawkishness for the Fed, you do have that global financial conditions cushion. And I think what the Fed could do is use less balance sheet. So instead of having the balance sheet run off, they allow that to be a little bit more supportive. And then on the other side, we also have China, who again has been stimulating their economy for the last couple of months. So maybe if you get less balance sheet runoff, less Fed hikes, more China support, and maybe some drawdown in the geopolitical tensions that we see in the couple of weeks, then we could start talking about the dislocations in risk assets.
I'll tell you one thing we've got right now, a bit of a turnaround. Mark, thank you. Mark McCormick there of TD Securities. Just to run through it, futures well off session lows. We're only down 0.5% now on the S&P. On the Nasdaq, we're down about 0.6%. Euro dollar totally turning around. The dollar index was positive about 0.8%, now essentially unchanged. Crude was higher, much higher, now coming back down to 120 after being through 130. Brent Tom was near 140, now 124.
It goes flow by flow based on the headlines as well. And one of the things here is the coordinated political response we're going to see. I'm going to go, John, back to Volkert's Landau of Deutsche Bank last week, which is Europe is going to, whatever the outcome here is of war, Europe is going to spend a lot of money to rebuild out defense. And that's one of the trends here where when there's not grim headlines, we get a lift.
As you've indicated, Lisa, this whole market recently trading like a meme stock, a penny stock. Do you make anything of this? In the last couple of hours, this turnaround, yields up 4 basis points, the dollar now unchanged, crude coming back a bit, futures off the lows?
The only thing that I can point to is what Maria Tadeo was talking about earlier, the new demands that Russia's putting out there. And Paul McNamara of GAM over in the United Kingdom also coming out on Twitter and saying it does seem like a fairly serious climb down in the requests. It seems like there is a growing sense in Russia that this is a failure for them and that there's some desire to walk away from it. I might be extrapolating too much, but it seems like that was sort of the pivot point for a lot of people.
Well, so far at least, the older this session grows, the more we see a recovery on the screen. So let's go through it. Futures down about 0.6% on the NASDAQ, Tom. We're down around about 0.7%.
Well, the markets are, you know, again, it's improving. I'm looking at the VIX, John, 35 and ugly 2 hours ago. It comes in, but still 33.75 shows the moment we're in.
I'm really looking forward to catching up with Diana Amoa, EM specialist, coming up very, very shortly on Bloomberg Surveillance, on TV and radio, with crude at 120. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The European Union is calling for fast action to ensure the safety of Ukraine's nuclear power plants, 2 of which have been seized by invading Russian forces. In a letter to the International Atomic Energy Agency, the EU Energy Commission urged Moscow to return control to Ukraine. It said missile strikes at Europe's largest plant and its recent takeover are unacceptable. A decree signed by Russian President Vladimir Putin will allow Russia and Russian companies to pay foreign creditors in rubles. It establishes temporary rules for sovereign and corporate debtors making payments to creditors from countries that, quote, engage in hostile activities against Russia. Russian corporate bonds denominated in foreign currencies have plunged to deeply distressed levels in recent days. And China has announced a GDP goal of about 5.5% for this year, at the higher end of many economists' estimates and quicker than the 4.8% expansion forecast by the IMF. Beijing is expected to stimulate the economy, loosening controls on the housing market and increasing infrastructure investment. And China is warning the U.S. against trying to build what it's calling a Pacific version of NATO and saying that security disputes over Taiwan and Ukraine should not be compared. China's Foreign Minister Wang Yi said today that the real goal of the U.S.'s Indo-Pacific strategy was to form Asia's answer to the North Atlantic Treaty Organization. Wang warned against calls to expand U.S. ties with Taiwan. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We are ready for any option. We're talking about the closed skies. We're talking about any type of security operations. We're talking to anyone. So whatever, whoever, whether it's the UN or any other or individual countries, we should act together.
That was Ukrainian ambassador to the United States on CBS this weekend. From New York City this morning, good morning. A turnaround in this market. We're now down 0.75% on the S&P. Off session lows, we're down to 32 points. And the NASDAQ down 0.8%. Yields climbing a bit higher, up 4 or 5 basis points to 177.68. We've talked a lot about crude this morning. Haven't talked much about the CPI report this coming Thursday. Just to bring you the estimates, 7.9%. is the estimate for this Thursday for CPI in America for the month of February. And Tom, just to go through some of the individual calls, Morgan Stanley at 8%. They are at 8% for Thursday morning.
How do you digest that? If you're me or you, Chairman Powell, John, how do you digest that?
What do you do with it?
Given the screen, what do you do with it?
What do we do with payrolls? We ignored it, right? I'm not sure you can ignore CPI this Thursday.
It seems distant away. I'm trying to get to Tuesday or Wednesday, again, within the tragedy of what we see in Ukraine. We have been remiss in that we have not looked at the Pacific Rim. We have not looked at emerging markets, the haves of commodities, and critically, the have-nots of commodities. We do that now with Diana Amoa, Chief Investment Officer for Kirkoswald Investment Management. We're thrilled she could join us this morning. Diana, absolutely extraordinary. Let me start with the have-nots of commodities. How grim will this be?
Early indications definitely point that in the absence of a fast resolution, it could be fairly grim for the have-nots. And by the have-nots, we are talking about the net importers of commodities, but we're also talking about those countries that are highly reliant on manufacturing. So the manufacturing economies such as the Taiwan, Central and Eastern Europe, because we were starting to get out of the global supply chain, but that's now actually the issues are being exacerbated. So we're hearing more about factories shutting down because they can't get access to the core components they need to keep manufacturing going.
The first thing I looked at this morning in my early morning was Sing Dollar. I just wanted to know, what is Singapore doing at that junction where the tankers go north with all the hydrocarbons and all the commodities to a booming Pacific Rim? How at risk right now is the broader industry of the Pacific Rim?
From a sentiment perspective, you're definitely seeing that playing out in financial markets. But also markets are telling us something. Where you think about these small open economies that are highly reliant on exports, and especially exports to Europe, that is going to have a big impact on their output going forward if we continue to see the kind of pressures we've seen over the last few weeks, and if Europe especially stops growing and starts to contract, which is not inconceivable.
So where do you think is the biggest mispricing, Diana, of where we are at a time when supply chains are getting disrupted and we're seeing the price of basic staple foods soar to new record highs?
It's an interesting question because it's a conversation we've had here where if you're pricing something, you have a scenario to which you can anchor your expectations. We don't actually have a lot of visibility on how things play out from here. Case in point is the price action this morning. I know you mentioned that earlier, that we came in with a pretty dire market backdrop, and in the last couple of hours, things seem to be turning on some expectations that perhaps we're closer to a truce. In that context, it's hard to really know what sort of discount premium you need to be putting in assets. And so our preference has actually been focused on capital preservation until we have a little bit more uncertainty.
Diana, is this basically what everybody in emerging markets has been doing, because we are on the cusp of such a binary situation with possible disruptions to wheat output, that basically people are hiding out, and this could create a liquidity dry up that could be pernicious in its own right?
That's one way to look at it. But I'd say more interestingly for us, and it's something we're really focused on, is the flow picture. So we had the initial knee-jerk shock of the headlines, which markets were fairly fast to price and to add risk premium across most emerging assets. But in the last week or so, what we've started to see is outflows picking up in the space, an acceleration of outflows and fairly indiscriminate outflows. So even the countries that on paper look like they should be economically more insulated from the fallout on commodity prices, we're seeing money leave in that space. So until people have de-risked to the extent that they need to, I think it's going to be a bit too early to say that people don't have a position here.
Diana, at what point does the Fed exacerbate this? If the Fed goes ahead and hikes rates by 25 basis points, talks about reducing the balance sheet, is this going to become something of a spiral, or are we going to see it really taken in stride since it's basically been telegraphed?
It's been telegraphed, but I think it also it depends on what broader financial conditions are doing. So right now we've seen a little bit of tightening in financial conditions, particularly in the US, but it's only getting us to neutral. So they were overly easy before, now we're at neutral. If the Fed keeps on hiking into very weak stress markets, then you might start to see that spilling over. But to the extent that it's a measured hiking response, and there's an acknowledgement that the inflationary dynamics do actually require a hiking cycle, particularly in the US where the growth impact is less of an issue, then I think markets should be able to take that.
Diana, we have to leave it there. Always great to catch up with you. As always, Diana Moore of Kirkoswald Investment Management. Futures have turned around a bit, down 0.6% on the S&P. At session lows, we were down by more than 2 percentage points. Lisa gave a nod to the Reuters story out in the last hour. I'll read you the first paragraph, Tom, from Reuters, speaking to the Kremlin spokesman, Dmitry Peskov. Russia is demanding that Ukraine cease military action, change its constitution to enshrine neutrality, acknowledge Crimea as Russian territory, and recognize the separatist republics of Donetsk and Lugansk. Peskov telling Reuters that Russia had told Ukraine it was ready to hold its military action, quote, in a moment, if Kiev met those conditions.
Those are the conditions, John, I believe, of before February 24th. I mean, I'm not the expert here, but to me, that's pretty much what we heard on February 23rd.
Going into it, though, they also asked for a change of leadership. I don't see that, Lisa, in these demands outlined by Peskov this morning.
Exactly. That's why a lot of people are saying this is a pretty significant walk back of the earlier demands. At what point does this indicate a willingness to come to some serious discussions about a ceasefire, and how much is this just basically lip service? Honestly, everyone's looking for an off-ramp, and it's getting harder to see one. Does this actually break that narrative, even just a touch? And is that what the optimism is that we're seeing?
Futures have turned around a bit. I'm not here to advocate in either way, and I know you're not either.
No.
We can just follow the news, give it a price action. We've turned around a bit. We're down 0.6% on the S&P. On the Nasdaq, we're down 0.7% into the bond market, shaping up as follows on 10-year yields, climbing a little bit higher, going into Thursday on 10s right now. Well, 178 at 5 basis points, Tom, and then that move on crude, pairing overnight gains back to 120.68.
Nice move, particularly in the yield market with higher yields. John, I would know we just get a first legit print on the 10-year real yield from when you did the real yield on Friday, negative 1.00%.
The nominal yields on twos up 5 basis points to, let's call it 153. On the bond market, shortly we'll catch up with Tony Rodriguez, the head of fixed income strategy at Nuveen. What a morning. Good morning. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las mediciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's a very tricky environment. Obviously, market reaction is about Russia, Ukraine.
Commodity prices have just been exploding.
We do think that once we get through this period of volatility, that things will settle down.
The consensus view in the equity markets is that this too shall pass.
There's a pretty significant cushion of momentum to absorb this shock.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us on an eventful Monday to the inflation report on Wednesday, Thursday. Guess what? It doesn't matter. This is markets in turmoil. John, in this hour, to go to Damian Sassower on the derivative space is critical with these massive moves we're seeing.
Working through our top story, Tom, an active discussion about banning the import of Russian crude. In Europe, will they come along for the ride? We get a headline from Germany's finance minister that reads as follows, Tom. They are against the push to ban Russian energy. The story we wrote this morning here at Bloomberg implied that the US was also considering, at least in the beginning, going it alone. Will they fly solo?
For Global Wall Street, you've got to stay with us for Paul Sankey coming up at the bottom of the hour. And John, when you saw that 140 print, I believe it was on Brent crude, yeah, we're down to 123, but 123 is distant from where we were 3 months ago.
I was thinking what everyone else was thinking, Tom. Demand destruction. We've been talking about it now for weeks. What does this do for the outlook for global growth, Tom? Yes, we might keep buying crude. What do we stop buying?
There is the international sense in Europe, and then Lisa Abramowitz, you bring it over to the United States. Moments ago, AAA unleaded published for Sunday. Yes, we hit $4 a gallon, and we jump out to $4.07 in 1 week, Lisa, from $3.61 to $4.07 a gallon.
And this is something that we've been talking about all morning, John and yourself, talking about the demand destruction, not necessarily for gas, but for other things. And there are signs that you are seeing billions of dollars in an essential gas tax as prices go up every increment. At what point does this hamper the recovery versus just slow things down and, frankly, give the Fed an easier job of perhaps not raising as quickly?
John, with your coverage of the continent of Europe ages ago for Bloomberg News, you've been way out front on the EU banks. That story continues this morning.
Well, Tom, there's two issues at play here. The obvious one, the direct relationship with the Russian economy. The one that's second but still prominent, we came into this year and people bid up European banks. Why? They thought the ECB would be a little bit more active relative to the previous cycle off the back of higher inflation. That story's got stripped out in a massive way. So look at some of the moves this morning. The index, the industry group overall is down 3%. But take a look at, say, let's pick a bank, Commerce Bank, down 5.5%. It was down close to 10% today. But the overall index over the last 30 days has lost a quarter of its value, Tom, in a really short amount of time.
Headline out right now, the president to speak with Mr. Macron, Mr. Scholz, Mr. Johnson, and Mr. Farrow by phone this morning. I mean, the diplomacy is underway, John, but I would suggest we haven't heard from Putin.
Well, as always, Tom, we've got to go through demands. We've heard from the spokesperson speaking to Reuters, and these were the demands, Tom. There will be talks later this morning, we understand, between Ukraine and Russia. Here's the quote from Reuters this morning. Russia is demanding that Ukraine cease military action, 1, change its constitution to enshrine neutrality, 2, acknowledge Crimea as Russian territory, 3, and then recognize the separatist republics, 4. What you didn't hear there, Tom, was force a change of leadership and remove President Zelensky. So that wasn't in the paragraph that we heard from the Kremlin spokesperson this morning. Tom, are those demands, how will they be stomached by the Ukrainians in those talks? Most people suspect not very well.
Yeah, I think the demands that were there days and weeks ago, and I don't think they're, from what I know, they're not going to be accepted. On the data front, John, I'm just going to go to the initial surge this morning, 3650 on VIX. We come into a better statistic, 3360 as well, but still some angst in the market.
A challenge of the week. Tell me what to do with US CPI and how to push it through this bond market. Inflation comes out Thursday morning, expecting it to be close to 8%. 10s are at 177, 2s are at 150. Tom, we ignored payrolls. What do you do with CPI on Thursday? It's got to be a big question. We're ignoring it right now, but it's coming, just a few days away.
An extraordinary hour for you on radio and television. Jacob Frankel, the former governor of the Bank of Israel. Paul Sankey will be with us on oil. Damian Sassower on the derivative space. But we start strong with fixed income. And from Nuveen, Tony Rodriguez joins us this morning. Tony, the knee-jerk thing under crisis is yields lower. And then you and I know there's the and yen. When do yields start to move higher, pricing in this new embedded inflation?
Well, good morning, Tom. Good to be with you. I do think that ultimately you will see higher rates, and it will be as a result of the higher inflation pressures that we're seeing, therefore the response that we're going to get from the Fed starting next week. But in the near term, of course, all the focus is on the Russia-Ukraine situation, which clearly leads to a flight to quality, a flight to liquidity, almost no matter what market you're in. So in the near term, we don't expect to see substantially higher rates.
For our audience that aren't sophisticates, we'll leave the sophisticates for Damian Sassower in a moment. For people looking for coupon, price up, yield down, is that a gift where you readjust?
We do think it's an opportunity to readjust from a duration perspective. Since we think rates will be higher, you've seen a pretty dramatic repricing here in the last 10 days. You've also seen a pretty dramatic repricing, obviously, outside of the Treasury market and risk assets. In the near term, it's very difficult. Everyone's crystal ball is pretty foggy. But when you go out a couple of weeks, ultimately we think this plays out into higher rates and into risk assets that should perform much, much better in the second half of the year. So it is an opportunity to reposition. You just don't want to try to hit a home run here. You need to basically scale into your trades and do some solid analytical work to make sure that you can withstand this period of pretty intense volatility that we think is going to continue.
Tony, where are you on growth with crude at 120? I'm looking at the consensus on the Bloomberg. ECFC for the median forecast, 3.6% for US GDP in 2022. Are you anywhere close to that?
Well, we would be at around 3.5% to 4%, assuming that this spike in oil is only for a few weeks. To the extent that it stays with us well into the summer, then clearly we have to mark down our growth expectations closer to 3%. As you start getting below that, that's when you start getting closer to that, risk of stagflation, risk of central bank policy error, and then you start to pull forward recession risk into early 2023. That's not our base case, but that's certainly what we would have to start to do.
And Tony, to that point, building on John's question about the growth scare that people expect if this does continue, how much of that is being priced into, for example, riskier credit when you see spreads widening, yes, to the most going back to December of 2020, but still not anywhere close to some of the peaks that we've seen in recent years?
Well, you make a good point, Lisa. We certainly have repriced. We've seen obviously a stronger repricing in emerging markets than we have in high yield, and obviously less in investment grade markets. But we are not pricing in recession. Again, our view is that recession is probably a 2024 question, depending on how policy rolls out. But to the extent that we start to see inflation prints that don't start to ease by, call it May, June, and this conflict extends such that energy prices have found a new equilibrium level, we think they will kind of recede from here. But if they don't, then you're clearly going to have to see wider spreads to price in a greater risk of a recession coming earlier in 23.
Tony, historically, people have looked at credit markets as the canary in the coal mine, an early warning signal of distress. Have they lost that moniker with the influence of the Fed?
I don't think they've lost. I think that maybe the Treasury market has, because there you have such dramatic involvement from the Fed with the size of their balance sheet. But when you start looking outside of the Treasury market into risk markets of emerging markets, high yield, investment grade credit, I think they still are a reasonable signal.
Tony, always wonderful to catch up with you, buddy. What a week we've got ahead of us. Tony Rodriguez there of Nuveen, all looking ahead to Thursday, CPI in the morning at 8:30 Eastern time, followed by an ECB news conference with President Lagarde and a decision 45 minutes before that. Thursday, Tom, as you said a couple of hours ago, feels like a long way away.
Long ways away.
A long way away from where we are at the moment.
Forever away, and whether it's Christine Lagarde and the weight that she has, the pressure she has, and even to get to March 16th, John, it is just so far away. Again, I'm looking for the cogent response to Mr. Putin, and we saw that with the formulaic, I should say, statement this morning, but we need to see more about what he plans to do after this war in Ukraine continues forward.
What do you make of these talks, Tom? The president speaking to Macron, Schultz, Johnson by phone this morning.
If I have to guess, it's one last go around to figure out sanctions where everybody saves face. And I think the most important thing this morning has been Prime Minister Johnson once again speaking a different tone than the continent.
I think it's important also, Tom, to suggest that the sanctions already announced have had massive consequences
massive.
Already. Much bigger than I anticipated, you anticipated. Every single morning we sit here, there's another one, there's another one, another company pulling back.
Bloomberg opinion, John, this morning is exceptionally strong. Adrian Wooldridge with just a tour de force on the history and scope and scale of this. And moments ago, James Stavridis has published, I'm trying to get that out on social media. John, under Stavridis' command of the European U.S. Army, we've gone from 400,000 troops down to 100,000 troops. He writes a blistering essay to rebuild the military force in Europe.
We're seeing that, Tom, aren't we? The defense spend in Germany, the UK.
Folkets Landau led with that. Folkets Landau led with that in terms of fiscal stimulus in Europe.
We've seen some massive changes, Lisa, in a really short amount of time. We've inflicted a ton of damage on President Putin's economy. What's changed for me, though, in the last couple of days, it is less about just inflicting pain on the economy, and we start to introduce this moral question, which has really complicated things for the US and for the Europeans alike. Before it was, let's insulate our economies, let's not do anything about energy. Now this moral question has been introduced. Is there a moral obligation to pull back from it all?
It's hard to avoid the moral questions when you see some of the images coming out of Ukraine and the humanitarian disaster in many areas.
Absolutely heartbreaking for everybody. From New York City this morning, good morning to you all. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. An advisor to Ukraine's president says the next round of talks with Russia will begin later today. Russian forces have stepped up their nighttime shelling of cities in the center, north and south of Ukraine, according to a Ukrainian official. That comes as an evacuation from the southern city of Mariupol has been stopped for a second day. Ukrainian officials claim Russia has again violated a temporary ceasefire deal brokered to allow the safe passage of civilians. The U.S. House of Representatives is looking at a bill that would ban the import of Russian oil and energy products. That could add economic pressure on Russia following its invasion of Ukraine. The Biden administration is said to be thinking about making the move on its own if it can't get its European allies on board initially. And South Korea is seeing record early voter turnout, even as the country battles its worst outbreak of COVID-19 infections. More than 16 million people, almost 37% of the total electorate, are said to have already cast their ballots. That's 11 percentage points higher than the last election. And the death toll from COVID-19 has crossed the 6 million mark as the pandemic enters its third year. That grim milestone was reached despite the distribution of vaccines that have slashed fatality rates in many areas. The latest 1 million recorded deaths came more slowly than the previous intervals, but the pace has returned to what was seen during the first year of the pandemic. And Hong Kong's COVID-19 death rate is now the highest in the world after fatalities amongst the city's under-vaccinated elderly surged. There are concerns the surge will get worse as infections spread through care facilities. Hong Kong announced more than 25,000 new cases today, as well as 161 deaths. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We are now talking to our European partners and allies to look in a coordinated way at the prospect of banning the import of Russian oil while making sure that there is still an appropriate supply of oil on world markets. That's a very active discussion as we speak.
Secretary Blinken over the weekend speaking on CNN from New York City this morning. Good morning. Futures down 0.6%. We recover. It's an active conversation with our European partners. Well, Germany's got this to say this morning. Germany is against the push to stop Russian oil gas imports. Crude, Tom, backing away from session highs.
Yeah.
Now a break of 120, 119.45.
We're back away from where we were 2-3 hours ago. But, John, this is the first time I've mentioned this morning. 210 spread, the ultimate vanilla spread, under 24 basis points. I'm sorry, that is indicative here of the slower economy that some are modeling in.
All of this going into CPI this Thursday. We're looking for something close to 8%. Tom, I'm going through the commodity screen with you. Energy, metals, ag, GLCO, go on the Bloomberg terminal. Nice. Everything that is trading is in positive territory. That's the story this morning.
I'm watching nickel off London Metal Exchange with a huge exposure there to Russia. Now anticipated, Damian Sassower. He's Chief Emerging Markets Credit Strategist for Bloomberg. That doesn't describe his real job, which is to explain Derivatives 101, and he joins us this morning. Damian, I'm going to cut to the chase. 1998, intangible financials. The hardest thing to grasp here for global Wall Street is this is a tangible crisis. All of these are things. Yeah. How is that different for you?
Capacity versus willingness to pay, I think, is what you're referring to. In 1998, the reason we saw Russian default was because they could have paid on their bonds. They just chose not to. We're seeing exactly the same thing here over the weekend. We had Jay Newman, somebody I respect immensely, 15-year battle against Argentina, working for Paul Singer at Elliott. These bonds are worthless. So you have to now compare Russia and its debt to that of Venezuela, who, by the way, the U.S. is meeting with right now to try and restore relations so they can produce more oil, because that's where this is all headed. You guys have been spot on, focusing on the oil equation. You've done okay. But, you know, this is really, I mean, look, this is really where we are, and the West has to give Putin a way out of this in order for there to be an aftermath.
What is so important to me is, follow the Credit Suisse note this weekend, the bid. People don't want to be on the bid on a given item, and at the same time, there's people that don't want to be on the offer in a same item, and that comes down to the trust of the transaction, which comes down to collateral. Explain what collateral is to mere mortals.
Well, I mean, what you're seeing in some of the cross-currency basis swap spreads, the fact that European banks need more dollars because they have, what, 110 billion of exposure, a foreign bank exposure to Russia. They need more dollars because those rubles aren't worth anything anymore. So you're seeing these sort of the piping, the mechanism. We talked to Mark McCormick earlier today. He was stressing this. This is about access to collateral, access to dollars, dollar-denominated assets, of which Russia has very few right now. So obviously you see the pivot toward China. You see all the focus on the Russia-China relationship. And why isn't China doing anything? They're on the global stage here. Well, they're not doing anything, quite honestly, because it doesn't behoove them to do anything right now, right? They're going to be able to buy these commodities, energy, metals. You know, I think the only three commodities that I can track, canola, sunflowers, and I forget what the third one was, are the only commodity curves that are actually not in backwardation right now. So everything has skewed to the upside. It's just, it's unbelievable.
Damien, you mentioned China, and they did talk about their rock-solid relationship with Russia. They're going to continue. You laugh. But what does that indicate going forward in terms of the Chinese currency? And I say this because they are easing, and they are sort of talking about stockpiling certain grains and other assets. How do you game out what this means, how this affects China?
Yeah, it's a marriage of convenience, Lisa. I mean, that's exactly what it is, right? And look, it's a marriage that's going to work really well for the Chinese economy in the near term. You know, we saw the Congress over the weekend. We saw, yes, the rock-solid relationship between China and Russia reaffirmed. But beneath the surface, look, there is definitely some discontent, some seeds that are being sown there. And we are seeing a bit of a move on the West to try and extend some of, I don't want to say sanctions or anything, but they're looking as to what comes next. Is the yuan going to be at risk here? And you are seeing investors pulling out from Chinese-denominated assets.
Damien, you've got a couple of minutes to help me with this one. If I own dollar debt from either the sovereign or the corporate in Russia right now, and they try and pay me in rubles, what is that?
Okay.
Damien, can you help me understand all of this? What is any of it? What's a credit event look like in Russia?
Okay, so now we're getting into the bond mechanics. There are 6 bonds of the 30 billion in dollar-denominated Russian debt outstanding, where there is a covenant in there that allows them to make payment not just in dollars but other hard currencies, and they kind of slip the ruble in there. So I hope no one's holding those bonds, because you're going to get paid in rubles irregardless. But the fact that Putin is now out there saying he's going to repay all bonds, all dollar-denominated debt, and he's allowing the Gazproms, the Rosnefts, the corporates of the world to do the same thing, that's akin to a default, Jonathan. I'm sorry, it just is. That's how it's going to be interpreted by, in my opinion, the courts. And here's another thing within these. I mean, UK common law, which governs a lot of these Russian-denominated bonds that have been issued, it's not even clear whether or not the UK is the jurisdiction of choice here. So who's going to enforce, you know, in the event of a default, creditor rights? I mean, there's just no clarity there. Again, why Jay Newman of L8 is basically saying these bonds are worthless, and I can't disagree with him here. This is different than Argentina.
If we get that headline, that's what takes place. I mean, I don't even know if it clears the pipes. I don't know what happens on the other end, even if you do receive the money. I'm just trying to figure out, Damien, the consequences, the spillover of that, and whether we fully realized any of the stuff you and I discussing.
Yeah, well, Clearstream and Euroclear have already said they will not accept ruble payment on anything. They can't clear rubles, right? So it goes back to what Tom's saying. What is the clearing price for these assets? You know, this is an illiquid market. There is no clearing price yet.
Tom, what do you call it when the issuer tries to pay you in a different currency, but then the pipes don't clear the transaction? Is that a credit event or not?
It is.
It's a mess.
Damien, real quick here. We're going to run out of time, and we'll get you back like in an hour. You know, John can do you at 9 o'clock. That'd be great.
I just have to do some real estate.
Real simple. How do you construct a hedge at $130 Brent crude? How does a commercial vendor construct a hedge or re-hedge at $130.
Right.
That's not on my CFA exams.
Right. Well, I mean, we've always talked about it. Crude oil is a man's contract. I mean, the volatility we see in that contract is second to none. I mean, we can talk about the NASDAQ all we want, but it's crude oil, really. And look, I mean, what you see is this inverted curve. So look, I mean, if you are a hedger and you have front month, you actually can hedge to the back month and you get this positive roll yield. So actually commodities, if you're a commodity investor holding real assets, it's actually a very good time to be holding them because you're getting this embedded carry, which you never had before. Well, you haven't had it in 10 years, right? In most of these commodities.
Sounds like Bill Gross on the Mexican peso.
I mean, you're embedding carry into hard assets that don't pay a coupon. That's where we are, Tom.
Two-thirds of our audience just turned down the volume, Damien. Be quiet, John.
Damien, thank you. Damien Sasser there of Bloomberg Intelligence. Moments ago, we had some headlines from Chancellor Scholz. The EU energy needs can't be secured without Russian imports. Germany has no current plans to halt Russian energy imports. This coming from an emailed statement, Tom, from the Chancellor. Diversifying EU energy can't happen in the near term. That's the German stance this morning.
I'm making light comments here, but John, this is serious diplomacy going on as the president will speak to these allies this morning.
It's tough. Biden speaking to Macron, Scholz, and Johnson, Lisa, a little bit later.
And they have such different perspectives because they've got different outlooks. The reliance of Germany on Russian oil puts it Russian gas rather, puts it in a very different situation.
Speaking of different perspectives, speak to a commodities analyst and then speak to a commodity producers analyst and you might hear a different message. Paul Sankey, a conversation you do not want to miss. Coming up next.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number. And most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The United States would like a conversation about banning Russian crude imports. Germany this morning with a simple answer, 2 letters, no. Futures, negative 0.6% on the S&P. The Nasdaq down 0.7%. Germany seemingly does not want to participate. Crude fades just a little bit more, 118.30 on WTI. Brent crude yesterday, Tom, very close to 140 yesterday evening, back down to just south of 122.
Now, it's going to be interesting to see. John, what's so important here in this anticipated interview is it is 8,004 miles from Midland, Texas to Riyadh, and that is a world apart of global oil economics and the marginal economics of getting the marginal barrel out of the ground to be marginally refined. John, we can speak with Paul Sankey of Sankey Research.
We'll catch up with Paul Sankey right now. Paul, let's start right here. Often these conversations, and sometimes it's our fault, sometimes it's the fault of the people we speak to, we talk as if there is this special tap down in Texas that you can just turn, go down there and just turn, and all of a sudden crude output is up. Talk to us about how difficult that effort is, if we even tried to.
Well, I mean, it's even basic labor, but, you know, then if you get into engineers and just the ability to add capacity is being wildly exaggerated here simply because there aren't the people. And as Tom has referenced, Midland is kind of in the middle of the desert. In fact, it is in the middle of the desert. And there's tremendous competition from Austin for both labor and engineers. And so just in people terms alone, for commentators to turn around and say, you know, the US E&P industry should add capacity and volume is completely misguided. I was in Midland in late December talking to the service companies, talking to Diamondback, a major E&P there. And the fact is that things are drum tight prior to this crisis. And yes, they could add on a 1-year view, but there's nothing they can do this week.
Paul, they are damned if they pump. Environmentalists criticize them and investors punish them, and they're seemingly blamed if they don't. Paul, what do you make of the relationship between the administration and the oil patch in America at the moment?
I mean, absolutely appallingly badly managed because, of course, as you know, they came in with almost no oil expertise on the basis that they would change the energy system. I don't know how you can change the energy system without oil expertise. And now you're in a situation where you're talking to Venezuela, you're talking to Iran, and you're basically pretty much not talking to Texas. So it doesn't make any sense whatsoever.
Paul, how much could they actually, though, influence the output in Texas quickly, given the fact that there has been a lack of investment, given the fact that a lot of this has been driven not by Washington, but by a lot of the shareholders that have looked for fiscal discipline?
Well, the point that John highlighted from my research yesterday was that if they try to aggressively increase capacity now, they're simply going to compete with each other. And Tom also picked up on the point, you're just going to inflate things more because all you're going to do is take the guys from the next door rig and put them on your own rig, and the list goes on, because it's not just about people, it's about steel, it's about cement, it's, well, as they would say, cement. It's even about sand, actually, at a given level. So there's just all sorts of tightness down there, because we know we were in a commodity squeeze already before all this happened, which is why it's so dramatic. The answer is, you know, if you really started to reorganize towards more capacity, you would begin to see an impact towards the end of this year.
So, Paul, what could this administration do? What would you like to see them do in order to support more domestic production as opposed to going to Venezuela, as you point out?
Well, the grand scheme, as you know, is nuclear with a new grid. But of course, you know, can we do that? The utilities don't really want it. You know, the utilities have a lot of vested interest and don't get the criticism they should. Nor does Amazon get the criticism it should for, you know, the amount of oil that's used to deliver a package to everyone and return half of them. You know, all of this stuff is not really examined in the grand scheme of things. But above all, what the industry wants is consistency. So one of the latest things that we're seeing is suddenly they're saying we'll reduce the federal gasoline tax. Totally idiotic, just in terms of environmental friendliness and not encouraging efficiency. What they're saying is we'll take off the stupid mandate for ethanol that you know, being used. Again, just as the industry is moving towards major investment in renewable diesel, the administration says, actually, we might have to change this because there's a crisis. It's a crisis management, and that's exactly what, you know, leads to what I call the energy regression. We're in an energy regression. We're going backwards.
Paul, let me go to the third rail, and it's not the expensive summer camp. That was the third rail this weekend. Let me go to the third rail of the Keystone Pipeline. Is it a valid economic project, and can it actually enhance United States energy independence?
Yes, I mean, it could, and absolutely more Canadian oil is an obvious outlet here to as a long-term solution, because obviously we have such a tremendous ally right there with the available oil, who, by the way, are doing a tremendous job of Scope 1 and 2 emissions reduction. So yes, that shouldn't have been delayed back in 2015, which was when the Obama administration first threw a wrench in the works. Actually, the Biden administration was just bad messaging, because by then the project was pretty much dead, insofar as the Biden administration canceled it as literally the first thing that they did. But yeah, you could easily resuscitate this stuff if you could get around the environmental opposition. Environmental opposition is local. You know, it's a problem of negotiating very specific issues. The latest one has been this Mountain Valley pipeline, which would release more U.S. gas from the Marcellus into the general U.S. economy and to export. And that's 96 complete with $6 billion sunk, and a federal judge blocked it for crossing the Appalachian Trail. You know, stuff like that just makes no sense environmentally.
Paul Sankey, gasoline, AAA unleaded from 360 out to, I believe, 407 in 7 travel days, if you will. In your head, where is the tip point on AAA unleaded where it really begins to affect our behavior?
450, so 450 nationwide, but then you add 60 cents to, well, that's the retail price, but then you have to add $1 in New York and $1 in California, you know, in the higher tax states. So you're going to get to 550. And by the way, that's in the post. That's going to happen because essentially the gasoline price is trailing the crude price, obviously quite severely.
So what happens when we get to 550?
Well, people change behavior quite radically because obviously there's a lot of discretion over how much you drive your car, which car you drive, whether you drive like a crazy idiot or, you know, very conservatively, whether you pump up your tires. We saw all of this in 08, Tom, and, you know, there's actually quite a significant ability to change behavior. What's interesting now is obviously that you have very low unemployment, and therefore people do need to drive. And so I think the elasticity here is going to be pretty sticky, to say the least, and I think we'll get to really significantly higher gasoline prices are absolutely guaranteed.
And Paul, that's the test, and I think this is really interesting for you and I to try and talk through, work out. It's an open question. In the Treasury market, when yields go higher, aggressively higher, we talk about how self-limiting a sell-off would be because it starts to bite the US economy and yields come back in. Does the same dynamic exist in the commodity market for crude? And I'm trying to work out what that might mean for, say, the likes of Oxy up more than 90% year to date. At what point do energy prices go too high for even energy equities to continue rallying with it?
Yeah, I mean, you get into the point of demand destruction. Obviously, Oxy was an outlier move because we now know that Warren Buffett was building a significant stake and seemed to want to do it entirely in a week. So, but generally speaking, if the market begins to believe the strip, which is now over 100 all the way down as far as the eye can see, then these things move higher, and it's really the back end of the price curve that matters, which, you know, is aggressively higher. I think because there's a total question mark over what Russia will look like in the future. I think there's two things here. Number one is that very good news this morning, Russia has softened its stance, and I think we see the markets coming back. Given that Russia is softening its stance and maybe at the point of admitting defeat here, quite possibly. That's the good news. The bad news is we may actually see Russia now permanently out of the market, you know, for multiple years, long enough to make a difference to the strip, at which point the future strip will be at 100, and these things are hugely undervalued against that. Once you get to 130, 40, 50 on a spot basis, obviously we worry about demand destruction, and really the big question here, and you guys debate it constantly, is what will the recession look like? You know, it's not a question of whether we get a recession, it's like what kind of recession are we going to get?
Paul, awesome, as always. Good to catch up with you, sir. Paul Sankey of Sankey Research. When we talk about the strip, Tom, let's just talk about, in simple terms, the contract table. April, May, June, July, August, all the way out to August this year, Tom. $100 a barrel north of that, all the way through the summer. It's the whole curve that just shifted up at the front end.
That's where the pros look, folks. The media is correctly always focused on the spot price, but there's all the future prices out. And John, that goes into the inflation report this week, and I think it's absolutely incredible to try to figure out the new duration of higher inflation. That's a huge mystery.
CPI 7.9%. That is your median estimate. The high 8.1. The low estimate 7.5.
Where's it in 90 days?
It's going to be a big number, whatever happens this Thursday, Lisa.
Yeah, and this is also not even including gas, right? This is talking about rents. This is talking about wages. This is talking about the cost of health care. You add that $4.50 breakpoint that Paul Sankey was talking about, and what does that do to the rest of the inflationary inputs? Does it actually dampen them? But then do we lead to a slower growth kind of paradigm? And that is what the Fed will be struggling with.
I know you enjoy catching up with Jay Poloski, Tom. Going to do that in about 20 minutes of TPW. Was very constructive on Europe, global synchronized growth for 22. How the story's changed in a few weeks.
You get beyond this war. Let's be sure we talked way too little today just about the agony of Ukraine. You get beyond it, and you have to learn to pick up the pieces, and Pulaski is an optimist on that, particularly on the Pacific Rim.
Didn't talk about Julian Emmanuel this morning either. I talked to him too from Evercore. Lisa, dropping the price target to 4,800 from 5,100. Of course, we're still well south of that already.
I was actually going to mention, we're starting to see those downgrades come in. It is notable, though, that even though he did bring in his estimate, he still sees gains on the S&P at a very tenuous time.
You know what I'm surprised by? We haven't seen the GDP cuts yet.
Yeah.
The forecast cuts, Tom. I was expecting a few of them already.
I agree. In their defense, the uncertainty is so great. I'm sure they're waiting and waiting and waiting to make those calls.
Futures down a third. We recover a bit more going into the opening bell. 50 minutes away. Crude 121 on Brent. WTI 117 on radio, on TV. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word, I'm Ritika Gupta. An advisor to Ukraine's president says the next round of talks with Russia will begin later today. The United Nations says that more than 1.5 million people have fled Ukraine since the war started, mostly to Poland and Moldova. President Vladimir Putin has repeated that the war will continue until Ukraine accepts his demands and halts resistance. The European Union is calling for fast action to ensure the safety of Ukraine's nuclear power plants, two of which have been seized by invading Russian forces. In a letter to the International Atomic Energy Agency, the EU Energy Commission urged Moscow to return control to Ukraine. It said missile strikes at Europe's largest plant and its recent takeover are unacceptable. A decree signed by Russian President Vladimir Putin will allow Russia and Russian companies to pay foreign creditors in rubles. It establishes temporary rules for sovereign and corporate debtors making payments to creditors from countries that, quote, engage in hostile activities against Russia. Russian corporate bonds denominated in foreign currencies have plunged to deeply distressed levels in the past few sessions. And China is warning the U.S. against trying to build what it's calling a Pacific version of NATO and saying that security disputes over Taiwan and Ukraine should not be compared. China's Foreign Minister Wang Yi said today that the real goal of the U.S.'s Indo-Pacific strategy was to form Asia's answer to the North Atlantic Treaty Organization. Wang warned against calls to expand U.S. ties with Taiwan. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
First step in building a connectome is to get your hands on some brains and then cut them up. It all sounds very grim, but Harvard turns out to be quite efficient with its brain harvesting. Jeff's lab can do a year's worth of research with a single mouse brain. Small chunks of the brain are fed into the slicer, where a diamond blade carves off a thin sliver of tissue. The tissue floats along some liquid and onto a piece of tape. The brain slices are then put into this very large machine, where they're photographed in the finest of detail. Software helps stitch the pictures back together into a single 3D image, and algorithms are applied to help make sense of what's going on inside of the brain.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm here at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. That Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
It's important to recognize that the likelihood of removing Putin from power is extremely low until the moment that it happens. And so it's not very useful to speculate on when it could happen, but it's important to understand that the pressure is there.
Ian Bremmer with a piercing interview there earlier this morning with markets truly unraveling. He's, of course, with Eurasia Group. We have a better tape right now. Lisa Bramwitz and Tom Keene to move the conversation forward. Still, Brent crude, $122 a barrel. Looking quickly at the Russian ruble. My eyes are failing me, Lisa. Oh, there it is. The Russian ruble, 137, weaker from a 76 level of long ago. Still immense tensions at this moment of this war in Ukraine. It is our great pleasure now to introduce the former governor of the Bank of Israel, but far more than that, the Rockefeller professor at the University of Chicago, just a few years ago. Jacob Frankel, it has been far too long since we've seen you working with Mr. Diamond at JP Morgan. He comes to us today from his Tel Aviv. Professor Frankel, let me cut to the chase. Joe Stiglitz talked about globalization and its discontents. We have globalization and Mr. Putin's discontent, or Mr. Putin's grievances. What will come after?
Well, remember, since the collapse of the Soviet Union in the early 1990s, the entire world was excited to embrace Russia, to embrace China, to bring them into the group of nations. The G7 has become G8, the G20, WTO, the World Trade Organizations, all brought them in, and both China and Russia have benefited immensely from being integrated into the world. This has been a great period, which unfortunately During the past few years, with the emergence of the trade war, and now with the invasion of the Ukraine, has inverted it all back. Russia will end up being much poorer. They are suffering on a day in and day out. They are isolated. They are secluded financially, economically, politically. And the question now is, how will the world look like thereafter? I think that, unfortunately, to my mind, the globalization will be part of the legacy of the past, and we will now move to a new world order in which democracies of the type of the US and Europe will be on one side, and other countries, autocratic countries like China and Russia, will be on the other hand.
But Jacob, how do we get to that place, considering the intertwining of the supply chains, as we've seen, that we still haven't moved away from? Even with the pandemic, a lot of companies have kept their factory footprints in China.
Indeed, they've kept them in China because it was economically warranted. And I believe that they will continue working with China. China sees what happens with Russia. So while it does not take clear sides and does not join the world in condemning what is happening in Russia, by the same token, it takes the so-called, in their language, the middle ground. So China will continue to be a partner, but it will be of a different nature, not of camaraderie, but of self-interest.
Jacob Frankel is a former governor of the Bank of Israel. A bit of a delicate question, but I will ask it of you. What is the place of Israel to negotiate some form of better place in this war in Ukraine?
Well, I believe that the place of Israel is to be wherever it is found to be useful. And in this regard, when both the US and Russia and the Ukraine have approached the Prime Minister of Israel in a request to see if he can bring some common sense, even though the chances are not very high. Like most cases of such negotiations, Mr. Bennett decided to jump to the water and to see if he can bring a little bit of cohesion. But I can tell you, this is not an issue, it's a big, big issue. So even a progress of 1 inch is a progress.
Jacob, right now we're getting a sense that the U.S. is working on striking some sort of Iranian deal, a nuclear deal, in order to unleash some of the oil supplies there. I know this is a delicate issue for Israel. Is there more willingness in the nation to allow that type of deal and actually support it, given where we are in the commodity space?
Well, we are so much now in the midst of everything, and to get into the kitchen when there are important chefs in it is never a wise move to take. But what I can say is that given the situation that the US is planning, and effectively so, to ban imports of oil, it will be extremely important to find other sources. And other sources can come from Saudi Arabia, can come from other places that have it. So this is, I will put it in this context. What is important, however, is not to forget that and this has been the position of Israel all along, that the Iranian deal, the key word is not deal, but the key word is security and safety to all concerned. And if it compromises it, then it's not a good deal. And if it does not compromise it, then it is a good deal.
Jacob Frankel, thank you so much for joining us from Tel Aviv today. Of course, former international chairman at J.P. Morgan Chase, the former governor of the Bank of Israel. Lisa, just an extraordinary Monday, and I lose grip, if you will, because I guess we're doing better now with a ruble at 142. I just don't know what to make. I'm supposed to say, Lisa, the tape is better. Well, but from what?
Yeah, and I think that's very true also in the commodity space. Yes, you're seeing a lesser high in crude WTI at 118.82. Okay, great, but we're down. The low of just in December was $68.23. I mean, what we're looking at right now is a doubling in just a span of a couple of months.
Right.
So how do we say a better tape?
Let's go to the one thing I haven't talked about today, and it's what you're expert on, Lisa, which is how credit's doing. What is the gap between corporate paper and full faith and credit paper in America?
You're starting to see more concern. For a long time, there was very little concern, even as you saw crude prices pick up, as more people were worried about a growth scare. Now you are starting to see spreads widen out. That's the extra yield that investors earn over benchmark rates. It's at the widest level since December 2020 for junk bonds. Not at catastrophic levels by any means, still very low, but definitely starting to get concerned that this could start to bleed over into a growth scare and create a credit issue down the line.
And just one research note this morning out of UBS, Banu Bawaja and the corporate team looking at Europe. What a different story. And in Europe as well this morning. Let me run through the data here. Futures negative 17. The VIX at a 35 level earlier this morning is in a solid, even more, two big figures to a better 33.17, but still perched above the 30 level, shows the angst in the market. We will drive forward this conversation through the morning on Bloomberg Radio and Bloomberg Television. Much more to come as we continue to monitor the war in Ukraine. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A new week, the same tragic story. From New York City this morning, good morning, good morning. Futures recover down just 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. The war in Ukraine intensifies. The devastation in the country pushing Secretary Blinken to prepare for the next step up in sanctions.
We are now talking to our European partners and allies to look in a coordinated way at the prospect of banning the import of Russian oil while making sure that there is still an appropriate supply of oil on world markets.
Germany so far says no, leaving the White House under mounting pressure and facing tough decisions. Bloomberg reporting they could go it alone, writing, quote, the Biden administration is considering whether to prohibit Russian oil imports into the U.S. without the participation of allies in Europe, at least initially, according to two people familiar with the matter. Oil jumping overnight, surging as much as 18% before fading through much of this morning. Your team coverage starts right now with Bloomberg's Anne-Marie from the White House and Maria Tadeo in Brussels. AMH, set the stage for us.
Well, Jonathan, you really outlined it there, the fact that the United States might have to do this unilaterally, because we just heard from Olaf Scholz, the Chancellor of Germany, that they're just not there yet, and that Russian energy is just so important and essential to the European economy that they are looking for supplies, but it's not going to happen overnight. But, Jonathan, we should really note that even if the United States does take this stand and ban Russian imports of oil and other fossil fuel products, they're going to be behind the market, because for days there has already been an embargo, just not in name.
Maria, what I've heard from the Germans this morning is no from the finance minister and no from the chancellor.
Yeah, and they both control the money, so that just gives you a very clear indication of where they're going. And in fact, I just want to focus on the language that is coming out of Germany today. Chancellor Scholz says in a written statement, so there is no loss in translation here. These are the words on paper. He says there's a reason why energy has been exempted from these sanctions. It is vital, quote, for heating, electricity, mobility, and industry across Germany. Now, the question is, does Germany want to break away from this dependency on Russia? Of course, I'll tell you the answer would be yes. In an ideal world, we could just flip from one day to another, but there's an economic reality behind this, and this is a transition that you can't switch off overnight. So the mood music coming out of Germany is very different. They say we've exempted Sberbank and Gazprom from these sanctions for a reason, and it seems there is no turning for the time being.
Well, let's talk about the range of talks we've got today, including the talks between Ukraine and Russia, and then the American president speaking to European allies a little bit later too. Maria, I want to start with you and what we heard from the Kremlin spokesman in Reuters a little bit earlier this morning, basically coming up with a list of demands. I'll read them as follows. Cease military action, change the constitution to enshrine neutrality, acknowledge Crimea as Russian territory, and recognize the separatist republics of Donetsk and Luhansk as independent states. Now, Maria, your interpretation of what we heard from the Kremlin spokesman to Reuters this morning.
Now, here's the thing. When you look at the actual wording, you could argue the language is softer, because up until now, the Kremlin, remember this, they talked about a government that was full of Nazis. They talked about denazifying the country. They talked about Zelensky and his government being fascist and drug addicts. So the language, the envelope here has changed, and you could argue it's softer. The point now, however, is that the Ukrainian government is going to have to make a painful decision. Do we accept this, which on paper may seem softer, but there's no majority, let's make this very clear, to change the constitution as it stands right now in Ukraine. And we've seen this nationalistic almost fervor in the country as a result of war, where they say we will never forgive and we will never surrender. Or does he feel this is better than a full-on war that could last for weeks? Now, that is a question in the mind of Zelensky. Right now, we have no indication that he's willing to U-turn from his initial position. Having said that, we know there's talks that are currently ongoing between the two delegations, so we could get a hint later today as to whether this is something the Ukrainians can work with or not. But until now, there is no indication that Zelensky is planning on backing down any moment.
AMH, the president speaking to Macron, to Scholz, to Johnson a little bit later. What's the focus of those talks?
Probably going to be an update on where they stand, Jonathan, in terms of the sanctions, as well as any more aid they can deliver to Ukraine. You know, we have lawmakers back in session this week, and there's a lot of political pressure to do more for the Ukrainians, especially given the fact that President Volodymyr Zelensky joined a number of senators and lawmakers on Saturday on a Zoom call calling for more action. So I imagine that's where it's going to stand, and potentially, Jonathan, they'll talk about the energy issue, because right now, that's where the divergence is.
Anne-Marie, thank you. Always great to catch up with AMH. Stay close through the hour, Anne-Marie. We'll touch base with you again. Maria Tadeo out of Brussels, thank you. Your equity picture improves as this session grows just a little bit older. To discuss, Evercore's Julian Emmanuel, TPW's Jay Poloski, and Victoria Green of G Squared. Victoria, first to you. Can you help me understand the kind of price scenario that we're priced for right now in the commodity market? Are we already looking at Russian crude out of the market at 120 on Brent, 117 on WTI?
Sure, and I think people are already, like they talked about, self-selecting. You had the ports and the dock workers union in the UK refusing to unload Russian crude from a German flag vessel. You know, you're seeing this kind of rise up against Russian crude. United States may go it alone because we're a little bit better supportive of our own domestic production here. Like you showed before, it's only about 3%, 8% total if you look at all the oil and gas and fuels. And we can kind of absorb that, maybe continue to see our domestic producers ramp up production here. When you're talking Germany and the EU, which gets about 40-50% of its gas from Russia, or even Japan, which Russia is their 5th biggest importer, and they import a lot of their energy, it's just a different economic conversation than what we're seeing here.
Jay, is this a one-way ticket towards demand destruction?
I'm not sure, John. I mean, I think that Russia has occupied the headlines, obviously, for the last week or two. To me, the much bigger story is the story of COVID ebbing and the reopenings around around the world, from Asia to Europe to the United States. To me, that's a much bigger picture, and global growth, the way I'm looking at it, remains pretty decent and able to handle this. I do think we have priced in some embargo of Russian oil, at least, if not gas. And we've also seen nuclear in the headlines, and so we're discounting even that. I think we're very close to being finished with the downward price action from Russia.
Jay, isn't this just the same version with a different smell? Same messy supply chain issues, same story with prices, they're going higher. For the market, aren't we just replacing COVID with the tragedy of what's playing out in Ukraine and what it means for supply chain and prices?
No, I don't think so, John. I mean, I think, to me, Russia, you know, it is a tragedy what's happening in Ukraine, but Russia has done the global investors a favor, and that favor is they've taken out the risk of an aggressive Fed. The aggressive Fed was the biggest risk to global risk assets. The Fed was going to have to tighten until something breaks, namely the equity market. That risk has now been taken off the table. COVID is not even in the discussion. It is by far the single biggest factor, and it's going to lead to lower than expected inflation because people go back to work, because supply chains unsnarl. And it's going to lead to better than expected growth because you have the service segments of the European, U.S. economies, Asia, etc., reopening. Europe had record low unemployment in February, John, with the service segments of virtually the entire continent still shut. U.S. job numbers were way better than expected without COVID having fully ended.
It tells you a lot about where we've been. I'm not sure it tells you much about where we're going, Julian. We're going to a world where we could have crude north of 100 for a more sustained period of time through the year ahead. I'm not sure it's necessarily good news just because the Fed doesn't have to hike. We have to talk about the reasons why the Fed's not going to hike by the magnitude that maybe we were talking about a couple of months ago, Julian. Isn't that equally as important?
It is. Look, Evercore still thinks the Fed's going to hike 6 times this year. Okay. The issue is that whether you look at it in terms of consumer sentiment versus the spend, and the consumer sentiment has been very sour in recent months because of inflation, yet the spend has been strong, perhaps because of the anticipation of inflation, among other things. you have to reconcile all of these things, and that keeps the Fed looking at, really primary goal now, trying to make sure that inflation expectations don't get unanchored. And obviously, the other issue is this geopolitical risk could be the precipitating point where, in fact, we do think that you're going to get an element of demand destruction. We just don't think it is going to tip the country into recession.
I wonder what that means for the energy names. Victoria, you've been very constructive on them. They've done tremendously well through the year so far. At some point, though, crude goes too high, even for energy equities to keep rallying. At what point is that in our future?
Sure. I mean, oil over 100 is unsustainable, right? That's always been the tipping point. You look at the 90s with what we did in Iraq and Kuwait, and then we look at what happened in 08. Oil over this level is never a good thing. It's too much of a drag. We're about to hit our 08 high in gasoline prices at 411. I think we're going to blow past that. You're probably going to get 8% print on inflation, and this is just a drag on the consumer. We still like energy stocks because the bulk of ours are more domestic focused, and even BP and Shell with their divestments in European and Russian energy, they're still weathering fairly well. So even if oil comes back down, and hopefully it will, because that's a much more sustainable for economic growth, these have break-evens in the 40s in the Permian Basin. So we still think oil and energy is a good place to be, but we are wary commodities are 100% in a bubble. Look at what happened with wheat this week. WTI was up 25% last week. I mean, it was insane.
The gains year to date, 55% on Brent and WTI. Looking at the year-to-date column on the Bloomberg, it's just ridiculous, the price action we've seen. Jay, Julian, Victoria is going to stick with us. Secretary Blinken speaking at the moment over in Latvia, saying the United States does not want Russia and the conflict to widen, broaden. We know that. Reiterates something we've heard a few times now. Blinken saying the United States does not want the no-fly zone. The U.S. reiterating they do not want a no-fly zone, something the Ukrainians have pushed quite hard for. Your equity market, that story improves. Futures are negative, but certainly not as negative as they were earlier this morning, with some movers going into the opening bell. Here's Abby.
Hi, John. Well, yes, tremendous macro movement in the pre-market here for stocks, well off the lows, down just about 0.2%. Earlier, down 2%, as you know. And oil, it's really incredible, up just 1%. Earlier, it had been up 13%. Nonetheless, we still have energy as the top sector. Occidental Petroleum up 5%, and really an illustration of how two sides make a market, with Icon exiting Occidental Petroleum, and we have Berkshire boosting. Transocean up just 2.8% earlier. Both of these stocks up 9% when oil had been soaring. On the other hand, you have Citigroup down 2.8%. This as it has been downgraded to Jefferies to a hold from a buy on the company's targets provided in a recent analyst day. And then United Airlines, not surprisingly, airlines down, John, down 2.3%. This, of course, as jet fuel costs are absolutely soaring. Some saying that the airlines will have to reduce guidance on this.
It's going to get expensive. Abby, thank you. Futures, they recover a bit. We're down 0.25% on the S&P. Coming up, President Biden reiterating his unwavering support for Ukraine.
We're committed to helping Ukraine defend itself and in support of the humanitarian needs of the Ukrainian people.
That conversation next.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Russia invades Ukraine.
We have proven our strength.
The nature of this war changed yesterday.
Turn to Bloomberg for up-to-the-minute reporting from around the world.
Ground troops are closing in on the Ukrainian capital.
Swiss abandon neutrality.
And analysis of what it all means to you.
Energy is on the table.
We could see oil prices moving closer to 120.
There is a lot of interest to offload Russian assets.
Look to see more companies announce their exits from Russia.
Keep it tuned to Bloomberg Television and Radio.
We're committed to helping Ukraine defend itself and in support of the humanitarian needs of the Ukrainian people. And we're coordinating on everything from sanctions to export controls and broader global issues of energy security, climate, and human rights.
The war in Ukraine front and center, complicating matters for President Biden, looking to ramp up Russian sanctions while reining in surging prices for Americans.
I understand our top priority must be getting prices under control. Look, our economy roared back faster than most predicted, but the pandemic meant that businesses had a hard time hiring enough workers to keep up and production in their factories. The pandemic also disrupted the global supply chains.
Let's get to Bloomberg's Mike McKee. Morning, Mike.
Morning, John. Well, I've got some good news and some bad news for the president. We don't have a lot of episodes like this historically, but we do have one instance in which oil prices reached levels that they're approximately at now, could go a little higher, and that was 2008, before the financial crisis. And as you can see, what we saw then was gasoline prices following oil prices up, and that's the bad news for the president. The good news for the president is in that yellow line. That's the amount of oil produced in the United States. As you can see, we produce a lot more here than we used to, and it is a little bit less price sensitive than it used to be. So as prices go up, we are likely to see gasoline prices rise. But again, you go back to 2008, and that increase was relatively short-lived. Now, here's the danger. Looking at the February CPI, which is going to be the number of the week on Thursday, it's forecast to go up 7.9%. Oil is up 27%. You can see the weighting in the CPI, 27% since the war began. Gasoline up 16%, and wheat futures, which I'm using as a very rough proxy for food, up 61%. But at the same time, used cars, housing, and other parts of the core rate have been slowing. They're flat or falling in the last couple of months. And what that means is going forward, there's going to be an even greater divergence. You can see the big divergence there on the right-hand side between the headline CPI and the core CPI. Core isn't going to rise anywhere near as fast as headline. Consumers are going to be looking at the headline, which is a political problem for the president. The Fed is going to be looking at the core, which may restrain some of what they feel like they have to do. It's still too early to make a firm prediction, but based on history now, the Fed and the president may have diverging goals here.
Mike McKee, will the consumer wake up to a newspaper with the front page with an 8 handle? Thank you, Mike. Morgan Stanley says yes. This is their forecast. We see food prices up 0.9% in February, energy up 4.6%, together lifting the headline CPI up to 0.87% on the month. Year on year, 8% from 7.5. Julian, you can have this one. We ignored payrolls. Can we ignore that on Thursday?
The market does a reasonable job of ignoring the data. I mean, look, think about it. With this kind of data series, the last time we saw inflation of this nature, yields were 14%. Obviously, that was 40 years ago. So there is a certain extent that it can be ignored because the geopolitics does take center stage. But it really calls to question this whole debate that we've left the great moderation officially. We left it a year ago. And in a higher inflation regime, what's the right multiple on S&P 500 earnings? That's the real debate.
Well, Victoria, can I throw that question at you?
Absolutely. I think it's going to be an 8% handle, and I think the market will absorb it pretty well because you can just feel it. And I think gasoline's going to come up. Right now, we're 100%. Commodity prices are pushing up the market, and the Fed's got to move. Probably just 25 bips. They backed off the 50, but we still think 5 to 6 rate hikes. And I know that's a little bit different than 91. They didn't move in 91 when crude moved up. And obviously 07, 08, you were already seeing the markets kind of turn by the time before crude fully bubbled. But look, crude in this area has never been good, and it's always been followed by a recession. I'm not trying to be too Debbie Downer. I know the R word's a bad word right now. But if you look historically, when crude has started to bubble like this, when all your prices are coming up like this, and regardless, let's say we can find a solution that's acceptable in Ukraine quickly, I don't think sanctions are going to go away quickly. I think we're going to simmer back into a Cold War, and that's just going to drag on global growth. There's no way around. Europe's almost in a full bear market, and I believe they're going to have a recession fairly shortly just because of the pressure Russia's putting on them.
Strange things happen when crude goes through 100. We've talked about that repeatedly. You can look through history all the way back over the last 15 years or so. Julian, you talked about the loss of the peace dividend, the post-Cold War peace dividend. How important is that, Julian? Do you actually take that kind of thing seriously? What would that mean for this market?
It's definitely important. Look, at the margin, if you look at it, the last 30 years multiple has averaged 6 turns higher than the prior 30 years. There's a lot of things going on. Obviously, rates are much lower over this period, and they still are very, very low. But the psychology is changing. The psychology around a more persistent geopolitical instability, a more persistent inflation, and that's going to put a damper on what investors are willing to pay for what we think is still going to be, mid to high single-digit earnings growth this year.
Jay, you're more constructive on the global outlook than most people we speak to, and that's fine. That's your view. That's for the future. The future will dictate whether you're right or wrong. It's not for me to say you will be or you won't be. What kind of multiple do you put on this market when Julian and Victoria have those kind of thoughts?
Well, I would just point out, John, that, $100 oil today is not the same as 10, 20, 30, 40 years ago. Personal consumption, the U.S. average spend on energy right now is about 3.5%. It peaked in the late 70s at over 7%. There's nowhere near the effect on the consumer. Inflation expectations not unanchored at all. 2-year, 5-year, 10-year inflation forwards, all at 3%. The idea that the Fed has lost control is a media myth. On valuation, look, the U.S. is not my favorite region. I'm underweight the U.S. I'm overweight non-U.S. Europe sells at 13 times earnings. Emerging markets sells at 12 times earnings. China sells at its cheapest valuation relative to the U.S. in the last 20 years and has a much better policy mix than the U.S. does. There are lots of opportunities out there. I think Europe will emerge from this a much stronger, much more integrated and cohesive region. And equities are being sold at bargain basement prices right now, especially the banks, John.
Well, the banks are 25% lower than the last time you told me to buy the banks. We're going to come back to you on that, Jay. Jay, Victoria, Julian, I'm not letting that go, am I? Futures recover, almost unchanged on the S&P, down about 0.1% on the S&P 500. Coming up, the morning calls, and later, European bank stocks sinking to their lowest level in more than a year. What a vicious correction over the last 30 days. That's next. This is Bloomberg.
soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
In a few words, what a turnaround. For the S&P 500, futures were down more than 2%, now down 0.1%. For Brent crude, a bear market and a bull market in a single session. We were up 18% or something like that, close to 140. Look at this now. Positive just 1.74%, 1.7% to 120. That's the price action in the morning calls. Wedbush downgrading Ralph Lauren to neutral, forecasting slower revenue growth due to its outsized exposure to European consumers. Argus downgrading DraftKings to a hold, expecting a tougher macro environment amid increasing competition. And finally, Jefferies downgrading Citigroup to hold, identifying a number of upcoming headwinds during the bank's Investor Day. Coming up, the big banks under pressure, the war in Ukraine fueling monster losses in both the US and European financials. Going into the opening bell, a monster turnaround in this market. That's next. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The United States is having an active conversation about banning the import of Russian crude. The Germans this morning with just one word: no. No. Futures turn around in a massive way. Futures are negative just 0.2%. They were negative more than 2 percentage points. On the Nasdaq, we're down just 0.1%. Let's see opening bow, switch on the board and go straight to crude. What a turnaround here too. Crude has gone all the way from close to 140 and back down to south of 120. Right now on WTI, 116. We're positive just 0.4%. What a monster turnaround. Yields, I'm not sure what the bond market should do with any of this. We're up 5 or 6 basis points at 178.71. And the euro was deeply negative, a break of 109, and it comes back. We're down just 0.1% at 109.20. The whole market, trillions of dollars worth of assets trading like a penny stock in the last 12 hours. Let's get to the movers around the opening bow, 30 seconds in. Here's Abby.
What a wild morning indeed, John. And despite the fact that we do have crude off of those 18% highs on Brent crude, to your point, a bull market and a bear market in a single day, we still have energy movers leading the way. ExxonMobil and Schlumberger are both higher, the energy sector up about 1%. On the other hand, you have other pockets of the natural resources market not doing quite as well. Copper is down, so Freeport-McMoRan is down 2.8%. Albemarle, the chemicals and lithium company, earlier lower, now up about 0.6%. For a truly wild move, though, let's take a look at Bed Bath & Beyond. Right now, it is up 77%. Its best day ever, going back to 1992. And this, of course, is the Chewy founder and GameStop chair Ryan Cohen is taking a 10% stake, looking for a sale. Uber is up 4.7%. They have pre-announced the upside, raising the outlook. The rideshare market is really coming back. You can see that here in New York City. And then Occidental Petroleum higher with the wild action in oil, but also you have Carl Icahn selling his stake as Berkshire Hathaway is boosting their stake. So some green on the screen there, but yeah, wild, wild, wild.
Abby, thank you. This is such a tough market. If I sat here with you yesterday evening when crude prices started opening up and we approached 140 on Brent, would you have told me at the open we'd be down 0.1% on the S&P? That's where we are. European banks have been getting hammered over the last couple of weeks. Looking at that, here's Kelly Lyons. Say, Kaylee.
Well, John, they were getting hammered earlier today as well, but what was more than an 8% loss on the Stock 600 Big Index is now only a decline of about 1.5%. But of course, that is today alone. It has been brutal for some of these stocks in the last couple of weeks. The likes of Raiffeisen, of UniCredit, of SocGen, the three banks with the biggest exposure in Europe to Russia out of the European banks. Of course, all of those are also off of session lows, down between 2 and 3%. But we saw double-digit declines earlier on in the session, and all of them are down more than 30% on the year. Of course, they are at risk of direct hits, the likes of rising loan provisions, write-downs, maybe even having to pull out of Russia entirely. But there are also the ripple effects of the invasion that could weigh on the sector more broadly, like the pushing back of expectations of when the ECB will hike rates. If we see rates lower for longer, that removes a big part of the bull thesis for these European banks. So while they were outperforming earlier this year, they are now lagging the broader European market and lagging it quite hard. And just a point on how far valuations have come down. As we've seen this index fall 20% in just the last 8 sessions, they are now trading at only 51% of book value. But as we know, John, banks actually haven't traded at book value in Europe since the financial crisis.
It's been a while, Katie. It's been a while, that's for sure. Kelly Lyons, thank you very much. Jay, I promise you'll have your time to talk about this. Victoria, I just wanted to come to you for a moment. What do you make of a market that approaches 140 at the open on Brent, comes back down to 120? And we're talking about huge markets. I understand that relative to the equity market and fixed income, there's not much depth in, say, a physical market like the commodity market. I get all of that. But seriously, walk me through this, Victoria. What kind of a market is this to be up 20% 1 second, up more than that on Brent, and then be back down to almost flat?
It's definitely one that's moving at warp speed, and it's almost like when we came off of the COVID recession and we had an entire recession and recovery in like 90 days. The crude market is just kind of almost adding on to that and moving at warp speed. I think you're going to see these huge moves as we get more news out of Russia and Ukraine, and obviously at first it was, oh man, sanctions are going to completely cut off Russian natural gas and oil, and then it came out with Germany with that resounding no, and we may go it, but it looks like Europe may not. So then obviously you saw prices come back. I think think you have to be a little bit patient, and you have to realize this market's going to move very, very violently as we get new news. So let's say, hopefully, we get a ceasefire. You know, Russia finally came out with their terms today of what they're looking for. And you might actually see crude prices continue to come down if we can find some sort of resolution on the near-term horizon. Now, I think Russia's going to have sanctions still. I don't think we're very eager to really just forget what happened here if we can even get it resolved. But I actually look very positively at the fact that they came out with even, hey, this is what we're really looking for. And I always will go back to that Sun Tzu quote, you know, if your enemy's retreating, build them a golden bridge. And did we just finally find that out and that way to find a push forward to a peaceful resolution and negotiations? And when even China is saying you have to negotiate, that's when you got to start getting to the table seriously.
Well, Julian, I wonder if I can pose the same question to you. I understand the range of outcomes is incredibly wide here. 140 at the high end overnight, approaching that on the prospect of perhaps taking all of those Russian barrels off the market, for the US market at least. And then the Germans saying, no, I get it. But then, Julian, what you face as an investor is an incredibly wide range of outcomes. As an investor, what do you do in a market like that one?
So the temptation is to react to everything. And we would suggest that you just have to change your psychology to understand that this is an extraordinary time where you're seeing bull and bear markets all in the same day. And John, you haven't even put up, I don't think, the price of London natural gas yet, which is, you know, really outdone all of them so far today. Just extraordinary. And I think the key is we've had some conversations which, quite frankly, have been surprising in recent days, where people are actually nervous about holding cash because they view it as a depreciating asset in an inflationary environment. And while that's true over the long term, cash is very, very useful here because it enables you to keep your psychology sort of dispassionate away from these moves. And when the time comes, when there's a clearing of events, which we think there will be, you're prepared to act.
Stuck between a rock and a hard place, Julian, as you just described, even to go to cash. I'm looking at the European banks and where we were at the high of this year. We're down about 27% since then. Jay, let's come to you on that. Why you want to stick with this trade still? On the way up, of course, you were right. You were talking about the ECB introducing the prospect of interest rate hikes. That seems like it's dead and buried. It's gone. Why do I want to buy them now?
I don't know, John. Would you rather have buy oil today at 140 or European banks at half a book?
It's a good question.
I'll definitely take European banks at half a book. And that's that's what we have on offer today. And look, Morgan Stanley put out work over the weekend that the price action in the banks before today far exceeded the maximum potential loss from Russian and Ukraine exposure by the entire European banking system. So it's already well in the price. And to me, these things are opportunities. I mean, we run global multi-asset model portfolios, as you know, and it's been a golden age for asset allocation. You don't have to own energy stocks up here. I mean, I do. We took some profits weeks ago, probably a little bit too early, but I think selling energy here on a spike with the broad commodity index and backwardation at the most it's ever been makes a lot of sense. Book those profits, revert and put them into things that are selling at dirt cheap levels, oversold, maximum oversold, like European banks, like airlines, like the carbon credit system in Europe, which is down even more than the banks. I think there are opportunities across the board that are being presented here. And I would just suggest that the big story is COVID's ebbing and the reopening of the global economies, and the oil at these levels, as I pointed out earlier, isn't even halfway in terms of eating the pocketbook that it was when people casually refer to the 80s and the 70s. Completely inaccurate.
Well, Jay, I want to come to you on just a couple of things. Let's pick out on one. You framed it in an interesting way. Do you want to buy crude up here or banks down here? And a lot of people might sit there and say, okay, banks down here. But can you talk to me about time horizon? Because you often shape this investment as an investment over a long time horizon. Is that just a short-term tactical trade? Or do you have reasons to believe that through this cycle, and I have no idea if this cycle is going to last that long from here, who knows, but do you believe this is something you want to own through this cycle? Because if you believe that, you've got to believe surely that the ECB comes back into play, and so many people have their doubts about that still.
Yeah, John, I think that's an absolutely spot-on question. You talked about earlier markets having, going crazy in the volatility. You absolutely have to ride through. You have to have asset allocation. You have to have a process and a plan in order to succeed in these markets. And so you can't trade something that moves 20% in a couple of hours, and you shouldn't try because you're for sure going to lose money. And so the way I think about it, Morgan Stanley and others cut their European growth estimates for this year, cut it to 3%. The average 2015 to 2019 GDP growth in Europe was less than 2%. So even after all this, John, growth is going to be significantly greater in Europe this year than in the pre-COVID period. And I think that is sustainable. My view is that we're entering a multi-year period of better than expected high nominal growth rates and low and still negative real rates, which is quite constructive for equities where earnings expectations, as Julian pointed out, are single digit in the US and Europe. The bar is low. The bar is not high. It is low. I think we're going to have a resolution of Russia in the next couple of weeks. Time is not Putin's friend. He's completely reiterating the same demands he made last week. He's made no progress on the battlefield. Near-term resolution, oil reverses, banks rip, carbon rips, and please have me back on.
JL, Will, let me ask you this, though, and this is not a snarky question. I'm being deadly serious. What would make you dislike European banks, Jay? What would do it?
Yeah, I mean, it's simple. It's simple that we would go into a recession. We're not. We're talking about 3% growth. That's what people aren't getting. This talk about stagflation is completely inaccurate. We're going to have nominal growth rates in the U.S. of 6 or 8%. Pre-COVID, it was 3 to 4%. We're going to have nominal growth rates in Europe of 5 to 6%. Pre-COVID, it was 2 to 3%. It's a completely different environment. People are not getting that it's a completely different environment. The market is betting we go back to pre-COVID. I'm presenting a different view, which I think has a reasonable shot at success. And if I'm right, the positions we're in are going to do well. And look, we're taking some pain. I mean, our model, global multi-asset model's down about 5% year to date. It's not great, but it's not horrible given where we're at. And we got a lot of things that, like banks, like carbon, like jets, all down 20%.
It's brutal.
And I think we're going to see that upside in the next couple of months and quarters.
Well,
Growth
the ECB,
is going to be much
for
better.
sure. The ECB on
We'll
Thursday,
expect.
Jay, hopes you're right, without a doubt. If you're President Lagarde, and I'm listening to Jay Pelosky, I hope to God that everything you just said materializes. It's a lot more difficult, though, at the moment, Julian, for a lot of people to believe in that story for the year ahead. Julian, you see the upside in the US equity market. Let's not bury the lead for you. I have buried the lead for you. Let's finish with it. 4,800, down from 5,100. Why still anywhere near 5K? Why, Julian?
I think Jay really hit it, because even though we're going to have a growth slowdown, we are still going to have strong growth above the trend of the last number of years, both here and in Europe. And without talking about, how quickly Russia is going to resolve itself, rates are still low on a relative basis and an absolute basis as well. And again, for us, there are two things. If there isn't going to be a recession, you could go down 15 or 20%, but you don't go down 25 or 30%. And the earnings growth trajectory is likely going to be very supportive as we get to the second half of the year.
Victoria Green, you get the final word. The final word, please.
Respectfully, I think it's very important that you don't invest in value traps right now. Some places are valued the way they are because of what it might look like for future growth. And what happened with Russia is a fundamental shift, right? It actually should change earnings trajectories. We are still bullish on the United States. We do think this is going to be a drag. While we may have resolved COVID, you take Russia off the table, you're not going to have the global growth that we used to think we had. So you have to look at this and understand this was a fundamental change to growth expectations. The commodities are going to bite the consumer a little bit. The Fed's going to move. We are moderately bullish on U.S. equities, but you have to look and say at some point in the next 12 to 24 months, most likely we're going to have a recession because we're going to overheat.
Victoria Green, Jay Pelosky, Julian Emmanuel with a range of views. Victoria at the one end, Jay at the other, Julian somewhere in between. Coming up, the United States discussing a ban on Russian crude.
We are now talking to our European partners and allies to look in a coordinated way at the prospect of banning the import of Russian oil while making sure that there is still an appropriate supply of oil on world markets.
Sparking massive volatility in this commodity market. That's next. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
The no-fly zone, to be very clear about what that involves, that means that if Russian planes violate the zone that's declared, we shoot them down. And that runs the considerable risk of creating a direct conflict between our countries and Russia, and thus a wider war, which is in no one's interest, including in the interest of the Ukrainian people.
That is not something, a position that this American administration supports right now. The Ukrainians are asking for it. The Russians are saying, don't you dare. And America is saying, we're not interested. Secretary Blinken also over the weekend making several headlines. An active conversation about banning the import of Russian energy into the United States of America. Will the European allies join? The Germans this morning pretty clear. No, no, no. Julian Lee joins us now for more. Julian, this is such an interesting market at the moment with really wide range of outcomes, a really wide range of outcomes. On the one side, you ban Russian crude. On the other side, seemingly you don't. Julian, what on earth do you do in the oil patch right now?
I think it's an extremely difficult situation. I mean, clearly, it's much, much easier for the US to ban imports of Russian crude than it is for several European countries who are much more heavily dependent on it and have much less in the way of alternatives. So, maybe what we're looking at is much more of perhaps a piecemeal approach, perhaps a degree of self-sanctioning that we're already seeing with some countries banning Russian ships, perhaps banning Russian cargoes in time, import bans in those countries where it is feasible to do it. We're seeing a tremendous rise in crude oil prices, but we're also seeing a big rise in the discounts that Russia is having to offer for its crude, so it's not getting anything like the sort of headline prices for its oil exports. And maybe this is, at best a way of putting incremental pressure on Russia without perhaps being able to turn the taps off fully in a single go. But the other thing I think to bear in mind is we've had this announcement of a release of oil from strategic reserves held by member countries of the International Energy Agency. That organization or its members hold about 1.5 billion barrels of oil in strategic storage. The release that's been announced to date is for about 4% of that. So there is a lot more that can be done to release oil from strategic stockpiles. And I don't think this is going to be a sort of one and done with strategic oil releases. There are going to have to be more. And that may be a way of limiting the impact of reducing imports from Russia.
Well, Julian, I want to pick up on the self-sanctioning. And if the team in the control room can bring up that quote from Shell, the statement that we had from them over the weekend. Julian, this was fascinating to see Shell essentially justifying, almost apologizing for buying Russian crude at a discount, turning around and essentially saying the money we make on it will hand over to a charity. Julian, as you point out, we are already self-sanctioning. The oil producers feel embarrassed about dealing with Russia already. And I just wonder what the broader ramifications, the consequences of that are going to be going forward, even if, as you point out, the US don't make this decision.
I think that the ramifications are going to be that there is going to be a lot less Russian oil, whether it's crude oil or refined products, that finds markets in Europe or in North America. It's quite clear that there is a strong degree of public pressure against these trades. Shell, I think, as a company, if its corporate memory is long enough, will be very well aware of the damage that public outrage can do, not just to its reputation, but to its bottom line. I mean, I can remember the days of Brent Spar when they wanted to basically sink an old production facility in the North Sea. They eventually backed down because customers stopped buying their petrol and their diesel, particularly in countries like Germany. And if we see that kind of pressure on oil companies again, then I think we are going to see a significant reduction in the volumes that Russia is able to sell.
We're introducing a reputational issue here as well. Julian Lee, thank you, sir. Abby, we've talked about this for weeks now. It's company after company stepping back from Russia.
It certainly is, John. Just an absolute exodus. Any company that you can think of really has pulled ties from Russia, really cutting their ties from Russia, that self-sanctioning that you're talking about, sanctioning on their own, whether it's VW, Shell, IKEA, and Shell, of course, that controversial buy on Friday, causing them to do that interesting apology over the weekend, Netflix, Nike, Disney, and it's really hurting the Russian economy. If we take a look at what happened in 2021, big growth for Russia, energy of 59.3% export contribution for them, overall 46%, credit cards out to credit cards, Russia apparently reaching out to China, but it seems that these self-sanctions are working, cutting Russia off from the world, John.
Abby, thank you. 23 minutes in, stocks down 9 cents. Your trading diary up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Down not even 0.1% of the open, now down 0.7% on the S&P. For the crude market, a massive turnaround from where we were overnight. That's the price action. Here's your trading diary. President Biden discussing the war in Ukraine with European and UK leaders at 10:30 Eastern. European GDP coming up on Tuesday, the big one on Thursday with US CPI, plus an ECB rate decision and President Lagarde news conference. And finally, University of Michigan consumer sentiment to close out the week on Friday. From New York City, this was the Countdown to the Open.